Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 253rd VideoCast podcast for the week ending August 22nd, 2024. A lot of great stuff to cover today. We've got a special guest, which I'm going to get to in just a moment. But like always, we do family first, and then we'll get right down to business. This is me with the family, obviously getting steak as always before they went off to camp. So we had a lot of fun with that. And there is, girls went to sleepaway camp, so they're having all kinds of fun. Some pictures that the counselors sent back. It's pretty wild. They don't let you talk to your kids. There's Mimi doing archery. She sent an email. I tried archery. Quote unquote, I sucked at it. So there you go. And then, but she's having a blast, and so is Annabelle. This was in front of Fox last Wednesday doing Varney and Company. That was at Fox in the bullpen on the second floor doing Charles Payne, making money with Charles Payne. That's right in the studio. Before I was going to go on Fridays, they used the upstairs studio, so that was a lot of fun. That was at Yahoo on Friday. You can see the cameras there in studio. There's Julie Hyman, who I was on with. Right there, we did the stand-up in front of the TV monitor, and that's that. So our guest, before we want to give you a preview, is going to be Brendan Ahern. He lives out here in Connecticut with me, and we had a chance to meet, and he agreed to come on the podcast. Brendan runs the Crane Shares K-Web Internet ETF, China Internet ETF. So his top holdings are Alibaba, Tencent, all the names that you know. And he travels back and forth. He's had dinners with government officials, with company officials, with everyone. So you are going to love this podcast and love hearing Brendan's story. That ETF, KWEB, has $5 billion of assets under management. So we're going to get to that. What we're first going to do quickly in the first 10 minutes here is do the U.S. overview, because I know a lot of you want to get to that right now. The first one we're going to cover is Varney and Company. I want to thank Stuart Varney, Christian Dagger, and Preston Mizell for having me on. We discussed PayPal and GXO, and PayPal is important. PayPal's been up, went from 59 to 72 in the last couple of 2-3 weeks. You want to hear about that? And here we go.
It's because we have a nice rally going on our hands here. Dow up 300, Nasdaq up 250. It's come down a little bit from where we opened the market, but that's still solid rally. Thomas Hayes joins me to inspect this market gain here. Let me get this right. I read your stuff. You're suggesting we get a bit of a dip in the relatively near term, and then at the end of the year, a nice solid year-end rally. Is that it?
I think in the short term, Stu, when the music is playing, you got to get up and dance. That's what we're going to do for the next few weeks. However, we've got the first Fed cut coming in September. I think it's going to be a case of buy the rumor, sell the news, a little volatility after that first cut, a little volatility into the uncertainty of the election. Once that's resolved, we get a year-end rally.
No, we get a year-end rally.
We get a year-end rally.
Profits are strong enough to justify that, and rates are down far enough to justify that year-end rally.
That's right. We've got estimated 15.2% earnings growth for 2025. Things are strong. We just saw earnings season up 10.8% versus 8.9% estimates. Margins are holding in there. So, and estimates are actually steadily climbing up. So on balance, things are strong. Little strength here. Enjoy the fun the next few weeks. Get a little defensive ahead of the election, and then year-end rally. We're constructive looking out in the intermediate term.
Do we get a year-end rally if Kamala Harris is the next president of the United States? I don't want to get political with you, but that's an important question.
It's no question. I think the number one thing for the stock market, look, one candidate is pro-business, one candidate is pro-government. So there is that dichotomy right there. What the stock market needs to see historically is gridlock. They want politicians to be able to do less. So long as one party doesn't get all three branches, then we'll be certainly okay.
You've got a couple of stock picks. I want to start with GXO Logistics. Where is it now? Oh, $48 a share. Where's it going?
Okay, This stock fell 50%. Why? They do outsourced supply chain and logistics management. The reason is because you saw the shift from goods during COVID to services. That's balancing out. That troughed in Q4 of 2023. We've gone from the destocking cycle to the restocking cycle. The operating leverage in this business is huge. Management is expecting EBITDA to nearly double by 2027. So that implies the stock could not only double, but you get multiple expansion once they get the double-digit earnings growth and double-digit revenue growth back. So we think this stock can go up to $100 over the next 24 to 36 months, Stu.
No, you really do like it, don't you? Okay. The next one is PayPal.
Okay, everyone hates this.
Yeah.
This is a great business. Why is it a great business? Because Alex Chris came from Intuit. He ran half the business at Intuit. The stock was a 38 bagger while he was there. He's come into PayPal. He's increasing the margins. He's got this branded checkout called that increases conversion to 50% at the checkout to 80%. What does that mean? It means he can charge more. So margins are going up. They were supposed to do $5 billion of free cash flow this year. He said, no, we're not going to do $5 billion. We're going to do $6 billion. Oh, and by the way, we're not going to buy back $5 billion of stock. We're going to buy back $6 billion of stock. This thing is turning the corner. 429 million accounts. 10% of global enterprise spend. When you take an Uber, Stu, I know you love to take Ubers, that goes through PayPal, through Braintree. You don't see PayPal, but PayPal's getting a piece of that action. $500 billion of a $5 trillion.
He likes Uber the stock.
No.
Sorry.
You went through all this very complicated reasoning on those two stocks. You never looked down. You haven't got any notes in front of you. It's all in your head.
Yep.
Very impressive.
It's amazing when you have money at stake how serious you get about the stocks.
Oh, well said, son. Well said. Thomas, thanks for joining us. Thomas,
thanks for having me, Stu.
Appreciate it. All right.
And we're back. And then on Friday, I joined Charles Payne on Fox Business. Want to thank Charles, Nick Palazzo for having me on. This was an exciting segment. We discussed all kinds of seasonality and everything else, the elections, but we discussed Boeing and we discussed Cooper Standard. I want you to listen closely to this one. This is another one that's on the move again. Excited about that.
All right, so my next scene notes that earnings, margins, and estimates that they've held up, but the cavalry has to come no later than September. Joining me now, Great Hill Capital Chairman Thomas Hayes. All right, Thomas, who's coming to the rescue?
Well, I think it's time for the Fed to come to the rescue. We have a little bit of election year seasonality right now. We've got this August strength, which is normal since 1955. August is strong, the early part of September.
In election years.
In election years, since 1955. So you get a strong August, you get a strong first half of September. But interestingly enough, it rolls over late September, early October, which is coincident with the cavalry coming, doing the first cut. And what we also know historically is the market tends to sell off after the first cut, even though it's often up 12 months out, et cetera. So I think a little bit of strength. Let's dance while they're playing the music.
Right.
And then get a little conservative ahead of the election and year-end rally.
So that's interesting because I've always kind of seen you as a buy and hold, not necessarily a guy who says, hey, we've got to be a little bit nimble here.
Yeah.
Also, though, you're not big on the Mag 7. You do point out that their earnings growth is decelerating while the rest of the S&P is going up. But I'm going to put on the screen now, this is just one of the, it's decelerating, but for next year, Mag 7 at 20% is still the best outside of the Russell 2000, right? So even though equal weight is going to go to 12% from 5% and the overall S&P 14% from 7%, 20% is nothing to sneeze at, is it?
No, it's absolutely not. And I think the theme here is that they're going to have relative underperformance. So under the surface, the unmagnificent 493, you're going to see some stocks double. You're going to see some stock triple. There aren't many Mag 7 stocks you're going to see double and triple over the next 12, 18, 24 months. You're actually seeing it with all these activists buying up these cheap stocks that we're talking about. You know, like Nike, you saw Ackman, like Ulta, you saw Berkshire, like Starbucks, you see Elliott. So you see the activists starting to get into this cheap value, and I think that's going to be the theme for the next 18 months.
You know, I've been pointing that out to my subscribers as well. You can see it in some of these, and it's been some of these sessions where like, whoa, this is it. And these are names that are huge and just, you know,
that you can sleep at night.
Right. And, they, you know, listen, new management is amazing. I love when a company brings on new management. Okay, let's talk about money supply before we get to the stocks. Because money supply, you're saying, is picking up. So between money supply picking up and a friendlier Fed, isn't that a pretty good gust of wind in the sales in the market?
No question about it. So I think we get through this period here, a little bit of strength, a little weakness, a little uncertainty ahead of the election, but you cannot fight the increased money supply, $500 billion since the beginning of the year. The Fed will start to ease. All the risks that we're seeing, the cracks under the surface, defaults increasing, auto loans, delinquencies, et cetera, the cavalry needs to come to ameliorate that, because if you get into a situation, we saw little cracks in the labor market.
Right.
If they let that go, we could start to face deflation, and deflation is very hard to fix. Inflation they can manage.
I got 1 minute. Let's go over two stocks. Boeing, speaking of new management.
Yeah.
Now, it wasn't Larry Culp, which I'm glad, because I own GE stock, but this guy's got a pretty good resume.
Yeah, Kelly Ortberg, Rockwell Collins. He got there. It was a $7 billion market cap in 2012. He sold the business for $30 billion 6 years later. This guy knows how to create shareholder value in industrials. And
does he know how to keep a door on a plane?
Well, this is the beauty. Finally, at Boeing, we're going to have an engineer versus a salesman running the company.
Right.
His first day he spent on the floor of the factory, and the United CEO he met with yesterday, he says, I've got renewed confidence in Boeing now that I've met with the new CEO. This is a great thing. At the end of the day, it's a duopoly. It's good to be the king. If you don't want the
It's not only a duopoly, but if you look at the demand for aircraft, commercial aircraft, for the next 20 years, this was a stock that I used to tell people never to sell, and it's almost going to get back there. Less than 30 seconds. Cooper Standard. What is that?
We bought this in May of 2022 at $5.10. They refinanced the debt. It went up to 22. Now it's back down to 13. We haven't sold a share. We bought more shares, and I'll tell you why. Every single cycle in the last 45 years, you've had 18 million SAR is the peak, the sell-through total vehicle sales in the United States. We're at 15.8 right now. If they just get to 16.1, forget about 18, which they'll do this cycle, the business is going to earn $3 a share. You add a trough multiple of 10 times, you got a $30 stock. You add a peak multiple of 20 times, you have a $60 stock. And God forbid we actually get to 18 million SAR peak. This thing could fly. So we're excited about this one.
All right. Good stuff, man.
Yeah.
I like that you bring these ideas and no one else is talking about.
Thank you.
Good stuff, Thomas. Appreciate it. All right, folks. Kamala Harris.
And we're back. And then finally, I went over to Yahoo Finance to talk with Julie Hyman about one stock that we like and one stock sector that we would avoid. Want to thank Haley Marks and Julie Hyman for having me on there.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today we're taking a look at cyclical and defensive stocks. I'm here with Thomas Hayes, Great Hill Capital Chairman and Managing Member. Thanks for being here, Tom. Good to see you.
Thanks for having me.
So your buy stock is a cyclical stock, right?
Yes.
So we're talking about GXO Logistics. This stock has not done great over the past year. It's down a little more than 20%. This is one of the spins of the former XPO Logistics, which is Brad Jacobs' creation. And you like that he is involved in this particular company as well.
Yeah, Brad Jacobs has the Midas touch. If you got involved when he did United Rentals, you made a 47-bagger. If you got involved when he got involved in XPO Logistics, if you invested $1 million, you got $31 million. So he knows how to create value for shareholders. So you ask, well, then why is the stock down so much?
That would be my next question, yes.
So this business does well. They get paid for outsourced goods, okay? So they do supply chain, outsourced logistics. And there was a huge demand for goods during COVID. And then the demand shifted to services, and their business, the stock basically collapsed. The business did okay, and now that has troughed. Okay, so we've gone from the destocking cycle, which troughed in Q4 of 2023, and now we're starting the restocking cycle, and they have huge tailwinds behind them and basically operate in a duopoly with DHL.
So let's talk about the potential growth then. You're looking at EBITDA basically doubling by 2027.
This is guidance from the company. They expect EBITDA to nearly double by 2027. And what's interesting about that, Julie, is not just, well, if EBITDA doubles, maybe the stock could double. When you get that type of double-digit growth rate back, both on the top line and the bottom line, you get multiple expansions. So not only will the business do well, but the multiple applied to the stock could actually expand in the meantime. And that's why we see reasonably significant upside to this over the next 2 to 3 years.
Gotcha. And we kind of jumped the third point a little bit in terms of that restocking cycle just starting. But it's interesting when you talk about GXO and DHL. I mean, what's also interesting about that is, like, I think everybody knows DHL as a household name. GXO is sort of less known or recognized.
Yeah, he's not great with branding, but he makes billions of dollars for his owners. I got to be honest. I mean, he consistently does that. You know, they said something on the most recent conference call. Last holiday season was actually kind of a disappointment for GXO, for the retailers, et cetera. And what they're seeing right now in the month of August, he's saying the clients are getting ready for a good holiday season. It won't be shoot the lights out holiday season, but it will be more in line with a normalized holiday season, not a disappointment. Restocking is happening. This is very positive tailwind for GXO. And they just completed the Winkington acquisition in the UK. So they get close to over 50% of their business from Europe. UK is recovering. Europe's recovering. They just did a huge warehouse for Levi's in Germany. They're getting industrial business from different manufacturers like Boeing, et cetera, all over the world. So they're expanding verticals. They're increasing the duration of contracts with their clients. And it's a very sticky business. Once they outsource their business to you, you got them for life.
All right, so what could go wrong? Well, if it's a cyclical stock and that, restocking cycle doesn't materialize, that would be bad news. Yeah, that's a big thing. I think right now the only thing that could cause a recession is if the Fed dithers. They do need to go in September. We saw starting to see some cracks in the labor market, starting to see some cracks in defaults rising, even though they're historically low, auto loan defaults, et cetera. So if they move in September, I think we've got the tailwinds from earnings, we've got the tailwinds from GDP, and this will be off to the races. But if they get too cute with their cuts, that could be a problem. Gotcha. Okay, now let's get to your goodbye stock. And this one's a little contrarian here, Tom. We're talking about utilities. The XL, this group has been one of the winners of the year, right? And it's up almost 20% over the past year. But you say, let's hit the pause button. And in part, is that after the big run-up that we have had? Yeah, we were pounding the table last fall when you couldn't give away utilities. Everyone said no one needs energy anymore. I don't know what people were thinking. But basically, there was an expectation about rates that's different than the expectation right now. So this has rallied on two basic things. First of all, as a group, this is a defensive sector. It's up 50% in less than a year. So that tells me it's a little bit overdone here. That's a significant move. And the basis for this run-up, the AI narrative, which is slowing down, that trade is cooling, and cutting rates, it's almost a buy the rumor, maybe sell the news here. Right. In other words, people were buying in anticipation of the rate cuts. Perhaps once they arrive, the trade will lose some steam, you think? And finally, it's a defensive stock. And if you look at earnings, if you look at GDP, et cetera, I don't think you want to be overly defensive right now. You've seen staples have run up a lot, utilities have run up a lot. And you see it in fund managers, and this is usually a contrarian indicator. They're 1.4 standard deviations overweight utilities above the long-term average. So it's what we like to call a crowded trade, in other words. It is getting a little bit crowded, and I think it's a little bit overdone at the moment. Interesting. Okay, so what could go right for utilities? It's the opposite of the other ones. It's opposite day. If the Fed dithers and we go into a recession, you want to be in defensives. And this would do well, although given the multiple expansion that they've had already, it's like I don't see where the additional upside comes from. Well, or I guess if you have the continuation of the AI trade, and are the fortunes of NVIDIA the fortunes of the utilities, for example, as we continue to see a build out of AI infrastructure and the demand for power? Yeah, it's part of it, yes, but I think a better derivative way to play that is through natural gas, and I think those stocks are beaten down. So these have priced in the possibility of great things happen. The natural gas stocks are trading like they're dead. All right, save that for another future goodbye or goodbye, I guess. Tom, thank you so much for coming in. Appreciate it. We'll leave them wanting more, won't we, on this Friday? Appreciate it. All right, thank you so much for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern. Josh?
Hey, Julie. And we're back. So, I want to thank the folks over at BBC for having me on BBC Radio. You can play that on your own time. We're cut short. That's a short one. Want to thank Meta Singh for having me in her article on Reuters about the election. And I want to thank Reuters for having me on their article about the new CEO at Starbucks. We are going to cut right to the special featured interview conversation with Brendan Ahern. I'll tell you, we covered so much in detail about China, the economy, policy, Alibaba, other companies, This chart right here, the Hang Seng Index, I refer to numerous times during the conversation. So you want to have this in front of you so you can see what I'm referencing. This is critically important to getting the most value. So with that said, here we go. All right, well, we have a very special guest that we promised for you last week with Brendan Ahern from Crane Shares, and I'm so honored to have him on. He runs the largest China tech ETF, I think somewhere around $5 billion of assets under management. So, Brendan, why don't you just tell our audience a little bit about yourself, a little bit about your background, and how you got involved with China, of all things?
Yeah, it was totally fortuitous. I from the New York area, and after college worked for a big U.S. Mutual fund family. Ended up moving to San Francisco in a firm called Barclays Global Investors, which was the largest institutional passive and index quantitative manager globally. Was starting a thing called iShares, and I just had the kind of dumb luck of being a part of a small team, probably 24 people that they brought in all these very senior kind of captains of industry, and little old me. It was very clear it was a startup with a kind of a rich uncle, that we were in a different building than the rest of the company. So if it didn't work, they were just going to kind of unplug us. But it turned out to be an incredible success. And I had this great learning experience of being a younger person, being a sponge, and just wanting to learn. You had the former head of marketing from a very large U.S. fund family. You had the head of trading, head of portfolio management, the head of sales, heads of marketing. I'm in this little room with all these incredible people. So learn the ETF industry through and through. Ultimately, our parent, Barclays Bank, ran into some problems in the financial crisis, sold iShares and BGI to BlackRock. And, I'm from New York, so I'd come back and just walked up the street, with my box to BlackRock. Worked for them for a few years. Great company, incredibly successful company, and but wanted to do something more entrepreneurial. So happened to meet John Crane, American who had lived in China, built a successful business geared to China's growing urban middle class, but wanted to take what he did in the retail space, apply it to finance. And he was looking for someone to help build the company. And I was like, hey, if you want to build an ETF firm, I can help do that.
Wow.
So, really quit my job in the beginning of 2013. And, there's really just a handful of us, 0 clients, 0 assets, 0 brand. Started the company from nothing, really based on John's vision and gumption. And, so my job was to help make that vision investable. And that big part of that was launching, KWeb, our China Internet ETF, but also really trying to provide a balanced perspective on China's economy and capital markets. So that's a big part of what we aim to do. And obviously, we've done more things besides China, climate, and a few other things. But really, my day-to-day focus is on the China investment business.
So your timing was impeccable for a number of reasons. One, you basically got in on the beginning of the ETF wave. Granted, we had the Qs and we had the spiders, but really you were ahead of the crowd and you picked a niche which had an incredible run. And, one of the things that I was looking over the Hang Seng as I was getting ready for this call, and it's almost symmetric. Pretty much every 2 to 4 years, China has these, abysmal crashes followed by parabolic rallies. And here we are effectively 2 years into an abysmal crash in China. And you can't convince anyone that there's any green shoot or any light at the end of the tunnel. This time it's different. You've been doing this for a number of years, over a decade now in China. How is this different, or how is it actually the same?
I don't think it's different. We like to, our brains are kind of wired. I'm into behavioral finance, and our brains are wired to find easy solutions to complex problems like the stock market. And I think if you step back, big picture, from 19, I ran these numbers just now. If you go back and look at, there's a time period from, basically the end of 1999 through the end of 2009, U.S. equities had a negative return.
Wow.
Non-U.S. equities vastly outperformed, particularly emerging markets, particularly China, over that 10-year time period. And that, I think, this abysmal market in the U.S., where people gave up on U.S. equities during the financial crisis, because that was the second 50% drawdown. That was the foundation for this bull market. And so, in the 2000s, you had non-U.S. equities, particularly EM and China. And then it kind of flipped, right? When people were least prepared for it, we've gone backwards, where now the S&P 500 from the GFC low is up over 1,000%.
Yeah.
Non-U.S. equities aren't even up a third. So all country world ex-U.S. is not even up 300%. It's up 280. EM is not even up 250. China's not even up 150. And so people say, hey, this is American exceptionalism, but you forgot about the decade before. And what if the next decade it flip-flops again? And the one factor I've been following, Tom, is the dollar.
Yeah.
That the U.S. dollar was, went from being in those 2000s deappreciating. So non-dollar denominated assets to flip-flopping. We've had this incredible bull market just using the DXY, as a proxy. The U.S. dollar actually, from its bottom in April of 2011, actually went up just about 56%. The dollar's actually come off its highs in 2022, but if you think about a 50% return over call it basically 11 years, this is like a 3% tailwind U.S. stocks get every year versus non-U.S. dollar denominated. So there's actually some signs that the dollar is weakening, and we don't have to go into U.S. deficits, 34 trillion, and maybe the election and all that, but you'd say there's not a lot of fiscal responsibility in Washington D.C. and there's an argument the dollar's starting to reflect that, and if you believe whether or not the Fed cuts and to what extent, that would be a negative for the dollar. So anyway, I'm just saying that you can kind of see some of this regime change potentially taking place just in terms of U.S. versus non-U.S. and certainly China. China has had some real issues. I'm not saying it's all rainbow and unicorns over there. It's not. At the same time, the Western media narrative, I don't think is necessarily fair and balanced. Let's put it that way.
Yeah, I agree. It's funny, in the podcast, one of the periods we continue to reference as an analog is the 2001 to 2007 period. And you had a lot of similar conditions that, tech got overvalued as a percentage of the S&P, the earnings, et cetera. The dollar actually was super strong in 99, 2000. Then it rolled over. As it rolled over, you saw emerging markets in China have its most historic rally from 2003 to 2007. Commodities started to move with the weak dollar. The whole story. And if you look back, it's interesting you said about flip-flopping decades back and forth, because in the 80s, emerging markets and international did extremely well. And then 90s, you had this outperformance. And if you look at the kind of the U.S. narrative of late, decelerating earnings growth for the Mag 7, accelerating earnings growth for the unmagnificent 493. The good news is you can make a tremendous amount of money in the 493 that have lagged, where you can find value, and you're seeing activists go into, Starbucks and maybe not Lulu yet, but I'm sure they're, Disney, all these value stocks that are not going anywhere. But But with the weakening dollar, whether it's due to deficits, whether it's due to Fed policy, et cetera, historically, you have to look very hard to find an environment where the dollar weakens and emerging markets in China don't do well. Having been through cycles, you had these big drawdowns, obviously 2009, 2011, right before you guys got started, 2015, 16, 2019, et cetera, over and over. And then obviously the only one that replicated what we're seeing right now in terms of magnitude, besides 2009, was that 2001 to 2003. Can you give maybe your probably most recent recollection is that 2015, 16, kind of what was going on there? What was sentiment? What was unemployment like? Policy prescriptives, and how they're similar or different to maybe what we're seeing right now, and how you think about lights at the end of the tunnel, or it's just too hard to discern and you just got to hang in there with low valuations until something clicks.
Yeah, that was an interesting time period because you had China's economy was doing well. I mean, some of the Western media that there was ghost cities and shadow banking. But in China, no one believed that. If anything, the preceding time period was an incredible bull market, particularly in mainland China. So one important thing is that we always differentiate between mainland China, the Chinese A shares, so Shanghai, Shenzhen stocks, predominantly only owned by investors in China, and compare that with Hong Kong and US ADRs, which are predominantly owned by foreign investors. And the mainland went through a huge bull market, really driven by margin-driven debt.
Mm-hmm.
And that bubble burst. And when the bubble burst in the mainland market, that market, June, July, August of 2015, I've never seen any. I mean, that market went down for 3 months almost consecutively. And it took out kind of even though the offshore market had none of this debt driven, it kind of the perception, and then you had the Chinese devaluation of the currency, which again, you'd say, I mean, and this is what's kind of interesting is, you'd say, well, what's, China devalued its currency by, it was like 1% or 2%. But just as we saw a few weeks ago with the yen devalue, okay, if you're a normal investor, you're not using leverage. Yeah, if you're levered up 10 to 1, 100 to 1, 1,000 to 1, even what we just saw with the yen, that yen carry trade unwind just shows, the people that are really levered up, I mean, they're getting carried out feet first. And even though China didn't devalue the currency, which is, is kind of a currency adjustment, I would argue, more than a outright deval, it took out highly levered players. And the knock-on effect rippled through the global markets. And it was, like the yen. It was short-lived. So that was not really an economic malaise. It was actually almost the opposite of what we're seeing today. Today you couldn't give the shares of China away on the street. No one would be like, please, take it away.
Yeah.
I mean, and some of this, I would argue, it's just, if you think about, 15 years, that 15 years is, we're talking about 60 quarterly, times you open up your, brokerage statement, or your investment committee meets, or your board meets, or your trustee meets. I mean, it's really hard. And this isn't even China or EM, but really non-US equities. It's really, really, I mean, you get, as a professional investor, you go under a lot of pressure.
Yeah.
Like, hey, why do you own this stuff that always is a drag?
Yeah.
And you start whittling it down. and all of a sudden it's gone. And I think my little joke is, unfortunately Harry Markowitz passed away not too long ago, but diversification has died for many investors. I mean, there's one game in town, it's US equities. And then I would argue, there's a few pockets, ASML in the Netherlands, or TSMC in Taiwan, or Samsung in South Korea, but you almost got to cherry pick these individual names or these little markets. But there's one game in town in the US equities, and that breadth is even narrower, to kind of the Mag 7, and it's a global phenomenon. It's not just US investors, it's a global phenomenon, in my opinion.
And until it changes. And one could say that the US exceptionalization was certainly justified because the earnings power supported it.
100%.
Okay. But now with the CapEx investment, margins are coming down, and they have to do it because if they're not, that's their game, the digital game. So with margins decelerating and the dollar weakening. The other thing that you said about Chinese deval on their currency, the other thing that we focused on the podcast historically is that we need to see bond yields go up in China, and we need to see the currency start to appreciate in China. And just as they on a dime could devalue their currency, do you think we could see strength in there? Now, they might be holding back on the basis of, well, if Trump, it doesn't matter, Trump or Kamala, they've both been tough on China, comes in and wants to do huge tariffs, we're going to devalue to just offset the tariffs. So you can do all you want. We'll just cut our prices by using our currency. So tariffs are not going to be terribly effective against China. As a matter of fact, I read something that if they did a 60% tariff on China, it would affect Chinese GDP by 2 percentage points. So effectively, it'd go from 5% to 3%, which is still faster than the U.S. So it doesn't really serve anyone because we don't have any willing workers to go into to go into factories and deliver the type of stuff that we need.
We're definitely skeptical of the let's bring back pollution and carcinogens and let's destroy the environment. And if you want to bring it back, then volunteer to have a rare earth processing factory in your town. And there's just no way. I mean, we rich people outsource our pollution to these poor people, if it's emerging markets, if it's China or India or Bangladesh. And I mean, we're very skeptical. We think some of the tariff rhetoric this is the art of the deal. And if you think 60% tariffs you should short Walmart and Costco and Home
Apple.
It's just, unfortunately, some of the data gets lost in some of the political hyperbole, but we think it's, resurrecting Smoot and Hawley is not a very good idea for any political leader. And so we're very skeptical of some of the tariff rhetoric.
And by the way, as it relates to Japan, I think, yes, it's over. And I think it's more couched than over, because effectively the Japanese trade, it was not based on true underlying fundamentals or demographics. If anything, it's just the opposite. What it was is, we have to have Asia exposure. We're not willing to have China. Where do we go? We go to India and we go to Japan. Now, the fact of the matter is they've got inflation now and they have to hike. They hiked. The Fed didn't hike on that same day. You had a liquidity mismatch and you saw what happens, how levered it is, and the mismatch. The only reason it's quote unquote over is because the BOJ came out and said, our bad, we're going back. But they still have to move in that direction. They just have to wait for the Fed. So the Fed 100% has to go in September, because Japan was the global liquidity provider for the West for 2+ years while we were fighting inflation, buying bonds, buying equities, printing money. Now they need our help. We didn't come to their rescue in August. We dropped the ball. Powell maybe underestimated the impact of the leverage. But now in September, I think the Fed cuts. I think you're going to see BOJ shortly thereafter hike, because they don't want to, let inflation spiral out of control. That's going to slowly let the air out of the carry trade. That money's got to go somewhere in Asia. India's overvalued. China is going to go back to, in our view,
I agree 100%. I mean, I think a lot of the money in Japan and India came out of China. I think a lot of money, from Asia's gone into Mag 7.
Yeah.
And I think as the Fed cuts, that dollar weakness, it's really going to weigh on these Asian investors, particularly, in the EM world. Those EM central banks are raising rates. Around China, we see them wanting to ease, but they've not wanted to deappreciate. Every time the currency deappreciates, they get labeled a currency manipulator. So they're very hesitant to allow that. But the PBOC will wait for the Fed to cut and likely follow suit. They've cut different intra-bank lending rates and the loan prime rate and bank reserve rate, but they've really not cut broad interest because they're worried about the currency effect. And a lot of things you mentioned, the Chinese government's been very worried about strong fiscal stimulus because of the creating more debt in China, and we're starting to see a little bit of a change in tune there. It's slow. They've not wanted to do free checks in the mail, modern monetary theory, as we did here because of the effect on debt and inflation. So they're being much more prudent or conservative on fiscal stimulus, but we would say there's signs it's coming, and you're seeing it in the EV and the home appliance space. But even just very recently, the Premier Lee spoke about supporting domestic consumption more. So I think they're realizing that, okay, if the U.S. is cutting rates, it's because the U.S. economy, whether or not it's headed to recession, is slowing. And that's going to be a problem for export-driven manufacturers like Japan, like China. And so they're going to have to raise domestic consumption to offset the coming weakness in exports. And I think that's why you're seeing this slow pivot. I mean, there are other facets of why China's economy has been rather tepid. If it's the housing crisis and the effect on the consumer, the scar tissue of zero COVID, but they're actually, we're seeing these little talk of consumer vouchers starting. And I think that's where Alibaba, which really was really, well, John Crane showed me this picture of Jack Ma in 2012 and was like, the whole world's going to know who this guy is. And I was like, who is it? And he's like, this company's going to go public and it's going to change the world of investing. And to his credit, he was, John's vision came to fruition. But Alibaba is really the transmission engine for domestic consumption in China. And there's other players, Pinduoduo, TikTok, ByteDance in China, JD, but Alibaba is, a very well run company, and they're having had dinner with them. I guess it's been about 2 months 2 months ago in Hong Kong, and that I came away very confident in the management leadership and their vision for things improving. They've obviously been adversely affected by the tepid economic growth, particularly around domestic consumption. But I think there is a light at the end of the tunnel, and there's a lot that they're doing to try to change that as well from a management perspective.
Yeah. It seems like they're, at first they had the breakup because they wanted to say, look, the sum of our parts is greater than the whole, but it was a bad environment for the IPO. The other thing I wanted to quickly ask on the policy, it's been this slow drip for 12 months. Every week they are doing some level of mini stimulus, mini support. Do you get a sense that they're building, or they're just not enough? Like they just need they need a hard punch, or it's going to get momentum because it's compounding all these little things that they've been doing, these mini cuts, these mini stimulative things over the last 12 months. Any sense that we're going to see a dramatic effect from that?
Yeah, I mean, the President Xi and the top 200 leaders in China got together at this thing about a month ago called the Third Plenum, and the Third Plenum doesn't dictate policy, but it sets the direction. And the main takeaway from the release that came out of it was a clear acknowledgement that the economy is not doing great. I mean, that I think the market was like, oh, there was no policy, but that's not what they do. You know, China's a bureaucracy, and the message gets filtered down to these different agencies that then push it down. And the biggest worry is always policy error, and from the government. And the exhale I had was like, okay, these guys didn't put lipstick on it. They acknowledged there is a problem, and the question then is, what are they going to do about it? And I think people will say, well, why would they care about the economy? Or every government cares about the economy, because political regime change takes place during financial crisis. I mean, I mentioned Senator Smoot and Senator Hawley, just like President Hoover, did not get reelected in 1932, right? No different than Boris Johnson, or you could actually say, President Trump, because of COVID, the U.S. economy. And China is no different. China is not immune to this. And so the acknowledgement, and you're starting to see the super tanker doesn't pivot on a dime. But so I just say you're seeing a change in the tone and tenor from what's coming out of the government, and they're actually being more vocal. And I think the key, Tom, is there's a barometer, which is that Chinese A-share market. The Shanghai Shenzhen, that market is not doing great. And that is a vote of no confidence from the Chinese people on what the government's done so far. Now that doesn't affect us, because the internet names, the growth stocks, they tend to list outside of China, predominantly because they were funded by U.S. private equity. No different than ByteDance is owned by Americans. I mean, I just, this Chinese company, it's owned by Americans. Stop saying that. Just stop saying. But most of the companies we hold in KWeb, Alibaba was funded by Silver Lake, right, and Sequoia, and so those companies, the venture capitalists and private equity investors, they wanted a U.S. dollar exit, and that's why they listed here in the United States, or even Tencent is actually listed in Hong Kong, and that was to maximize value, right? Go to the biggest market possible.
So let's shift gears. One of the things we always say, we don't like to take country and company risk at the same time. It's part of the reason we've expressed our position through Alibaba. And I want to talk about the earnings here. First and foremost, we have something coming up in August 22nd, where we're going to have the vote to have the dual primary listing. And then if that's approved, which it appears that it will, then September 9th, we go live in Hong Kong, supposedly. So it's estimated, if you look at Tencent, if you look at Alibaba, if you look at Meituan, when it did the dual primary listing in 2019, it was up 17% in the first month. Some of the others not as much because they were in weak markets. It's expected that up to 10 to 15% of the market cap could come from China buyers over time. So you're looking at 20 to 30 billion dollars of buying power coming in over the next 9 to 12 months. Can you speak to that and the implications you think that might have?
Yeah, I think this is this is a big catalyst for the company. That Southbound Stock Connect is a program. There's Northbound, which allows foreign investors, like at Crane Shares, we do invest not in KWeb but in other strategies in the Chinese A-share market, and it allows a foreign investor to go through the Hong Kong Stock Exchange and buy Shanghai Shenzhen stocks. And the reverse is true with Southbound Stock Connect, which allows institutional and high net worth investors in China to invest in Hong Kong stocks. But it's not all Hong Kong stocks. They have to be Hong Kong eligible. And one of the requirements, there's been various requirements, and some of those rules have changed over time. They've relaxed. But if you're primary listed outside of Hong Kong, you're not Connect eligible.
Okay.
And so Alibaba, the shareholders will vote, to make its dual primary, which would make it southbound Connect eligible. And I've actually I've made some phone calls, between us to Alibaba to the Hong Kong Stock Exchange. What is the exact date? And I think people are being very coy on what is the exact date. So the September 9th, we've talked about, and I've seen some people kind of backtracking. Some people saying, hey, maybe that, maybe it could be sooner. Maybe it'll be a little later. But the key is it's coming. And just to your point, Tom, how do we know what's coming? Well, we did some comparisons. 10 which has about a billion users, just over a billion users of WeChat. It's China's Facebook, and Alibaba, the two main e-commerce, Taobao and Tmall, have about 900 million users. So you could say, well, what are the number of users? Or we could look at the number of shares or the percentage of market cap. So about 10% of 10 cents, call it 400 billion in market cap, is held. So you'd say, okay, about 40 billion could go into Alibaba. But you could say, well, Alibaba's only about 200 billion, so 10%. So we don't know exactly how much will come in. It won't come in day one, but you're talking about 20 to 40 billion coming in. I mean, this is a real number. I mean, this is a real catalyst. And, I kind of just say, like, imagine not being able to own Amazon.
Yeah.
You use it every day, and, it's like you're going to go Cocoa for Cocoa Puffs. Like, you're going to say, I can buy it, finally, right? This company went public back in 2014. So anyway, we see it as a major catalyst. And there's other things that I think are going in Alibaba from, some of the macro. There's been some fundamental reasons why Alibaba struggled, just domestic consumption, increased competition. But to me, ultimately Alibaba buying back stock, they're opening up a brand new headquarters. Yet those are not things that companies that are facing severe hardship do, right? You hoard cash. You don't build a new campus. But if you are a company owned by the founders, if you have those same entrepreneurs who started it, whose net worth is in the same stock as us, those are the things you do. You buy back stock hand over fist, and you build a new headquarters because you're like, okay, things are going to get better, not worse in the future.
Yeah.
In my
Yeah, no question about it. The second thing is when they are on the dual listing in Hong Kong, will they be able to buy back stock through the southbound Connect without issuing preferreds, or are they still going to have to issue preferreds to get cash out to do the buyback? Because that could be another major catalyst that's limited their, although they've been buying back and issuing preferreds at very favorable rates, it's limited their ability to do what they're able to do or potentially want to do without doing preferreds to get outside, cash outside the borders to buy back stock.
That's been my assumption as well, that Alibaba's revenues are predominantly in renminbi, which is why they did these the convert deal. That they don't have a lot of U.S. dollar or Hong Kong dollar revenues. So I think the Connect eligibility allows that to go through southbound. My assumption, and I can come back and confirm that, But my assumption is it would go through southbound.
Wow.
And therefore, they've done. I mean, Alibaba's done such a shareholder-friendly move of capping the convertibility to remove the dilution. I mean, this just shows this is the company is being very shareholder-friendly. They did the first dividend in December of last year. They're doing $1.64 in dividends for shareholders this year. This is a company that's done a lot of shareholder friendly. It's just if everyone owns Mag 7, no one really cares about and I would argue other peers in the space or the buyback yields of companies in the space. It's just out of sight, out of mind. It's there's other peers in the space that have gone down a similar route. I mean, I'm probably showing some of my own bias of being more of a buyer of baskets than individual plays, but Alibaba, I think, very, very. I mean, that was part of my dinner in Hong Kong with some folks from senior in the company who've been there a long time. Is just they have a very high vested interest in seeing the stock go up on a personal basis, and they're doing something about it.
Yeah.
That was kind of the takeaway is we're doing something about it. And if there was more of this disappointment that more other investors besides Crane Shares and yourself, Tom, are not picking up on this. But I think again, these regime changes from a market leadership don't happen overnight. It takes a little time, and I'd argue there's some signs of that. And I'm not rooting for U.S. equities to go down. Don't get me wrong.
Yeah.
Personally, I'm heavily invested.
Yeah.
Professionally, I have no exposure.
Picking up where we left off, one of the things I was talking about earlier was we don't like to take company and country risk. And when we wanted to get exposure to a weakening dollar and emerging markets, we saw Alibaba as the play to do that. Number one, because it's the national champion. I don't think that's changed much. And number two, in poker, and I played Texas Hold'em with some friends. I've had the same group for about 15 years now. In poker, you like a thing called outs. And what I saw in Alibaba was outs in the sense that the cloud business is kind of in its nascent stages. If you look at legacy cloud business, digitization of China is probably about 5 years behind the digitization of the US. And we saw Amazon's big AWS run from 2016 to 2021. And now we're shifting into the AI and GPUs, which they're catching up on. And then obviously, retailing is a tough business, as Charlie Munger always says. We had some market share loss, but that's showing signs of stabilization. So I would say two things. For those folks that, and then the third thing we wanted the ability to have some outperformance. So we wanted to be a little concentrated if we got the company right, and we got the country right, and we got the thing. But for those that are comfortable with just getting broad exposure, because when it works, and speaking to what you said before, these things don't happen overnight. But what we see, if we look back at the last 1, 2, 3, 4, 5, 6, I'm looking at 7 huge drawdowns since 1994. Even though they all took, with the exception of 1998, which that was just an acute situation, but most of them took 2 years to build a base. But once they turned, the turn was very abrupt and abrupt in a way that it almost didn't let anyone in once it started going. So yeah, they don't happen overnight, but meaning they've got to build a couple year base. But when they turn, it's like night and day. So maybe speak to that, number one. Number two, if people don't want to take company risk, and you referenced Alibaba being kind of the toll taker for consumption in China, I know Alibaba is one of your top positions in your fund. A, how can they get your ETF? And B, how would that give them broad diversification to when we do get that abrupt move in the right direction, and then opinion starts to follow trend, and they all go up in concert effectively.
Yeah, I mean, it'll be, again, I think one of the interesting things, my background kind of on the index methodology side is at the end of this month is MSCI's quarterly rebalance. And because India's outperformed China by so much within the EM benchmark, that India will be about 20% of the EM index, and China will be about 24%. China was closing in on 50% of the index pre-COVID. So one, you'd say this incredible fall from grace, but mathematically, if you think about India at 20%, China at 24%, well, India's GDP is 3.5 trillion and China's 18 trillion.
Yeah.
Does that make sense to you? So the indices themselves have a little bit of this momentum effect, and I think when you have very sector concentration, sometimes that's ringing the bell. And you saw that in the U.S. a few years ago, where the energy stocks were basically kicked out of all the indices, and then energy had to, so I think there's an opportunity for China at this point, and I think this index rebalance maybe is the ringing the bell at the top on the India trade, and maybe ringing the bottom for China, because you have some of these positives in terms of economic policy, but also just the incredible valuation of these companies, including Alibaba. I mean, one time stat that we didn't, that I always love to share, that I think you and your shareholders would love, is that Alibaba has very little debt, but they do have a few US dollar bonds, and they have a bond that comes due in 2031. And obviously interest rates have been rising here in the US the last few years. So that bond's lost about 6%. In US investment grade corporates have lost 7% over the last 3 years. But would you believe that bond is down 6% and Alibaba's stock is down 66?
Yeah.
I mean,
you can't make this up. And by the way, it's almost like in the US, when a company gets kicked out of the Dow, they tend to outperform over the next 12 to 24 months. It's funny that you brought up the energy trade, because that's kind of what put my podcast on the map during COVID. And we had a huge run because we were buying Exxon, the highest quality, in the most dislocated circumstance when oil turned negative. And it was like, I think the weighting got down to 2.5% from a peak of 10%. And it was the exact same thing. Pensions can't buy it anymore. ESG, you can't own it, blah, blah, blah. Until the price went up, and then opinion followed trend. And now these pensions can't get enough energy stocks. So history really does rhyme. It often repeats. And that's why I continue to emphasize that scenario in 2001 to 2007, because the abrupt move that we've had in tech stocks in China was very much like that period. And then you had the strengthening dollar go to the weakening dollar. I do want to shift gear. By the way, so Alibaba, in terms of the China Tech Index, that's one of your top couple of holdings. What percentage weight is that in the KWeb? It's
almost 10%.
Wow. So that's a huge position. How many holdings do you have overall?
We've got 32. We do cap the largest holding at 10%.
Okay.
That exchange traded funds are 40 Act mutual funds, so the Investment Company Act of 1940. So there are diversification rules we have to abide by.
Yep.
And we rebalance semi-annually, so as stocks go up and down, you can have movement there. But I mean, we were very early. We bought shortly after the IPO. That's kind of what helped put us on the map. Was we were the first ETF to own Alibaba, because we had this kind of fast track inclusion. And then we were one of the only ETFs at the time that actually owned US China ADRs. That most China ETFs only held Hong Kong stocks. So there's all these little intricacies to indexing, and that's kind of my background and something I'm into. It's like a cry for help, but
Yeah.
I sleep well at night. But popping the hood on this stuff really does matter. And a lot of the arguments against China is like, oh, well, it hasn't, the Hang Seng hasn't done anything or in 10 years or MSCI. But 10 years ago, the index was 50% two sectors, financials and energy.
Wow.
Like you had no exposure to the tech sector. I mean, the tech sector 10 years ago in MSCI China was under 3% of the index.
Yeah.
But that 3% actually outperforms the S&P 500 over the same time period, even though the benchmark in the aggregate. So that's where we kind of say, like, we wanted to kind of pull out, I call it like the good stuff.
Yeah.
These growth companies, the value, energy, financials, industrials, materials, real estate, those are slower, low growth sectors. And that was kind of the point of John Crane's vision in creating Crane Shares, is, hey, like, give people the ability to segment out these more growth companies, but you got to go in and get them, because particularly when we started 11 years ago, there was no exposure in the broad benchmark. So that's kind of the one of the key points about Crane. And then providing people with the data, that every day I wake up and I turn on the financial TV, or I read the local finance, and you'd think the world was ending in China, and again, when you go there, it's very different. And streets are crowded, the traffic's terrible, restaurants are crowded. Yes, there are issues without question, but I think if a Chinese doctor cured cancer, the U.S. headline would be China fires its doctors. There's just this constant negative narrative, and maybe that's where the U.S. government needs to justify its existence with a boogeyman. And the problem is U.S. investors are highly exposed to China.
Yeah.
And even that's through U.S. multinationals like the Teslas and Apples and Boeings and Caterpillars and Starbucks that are doing great in China. And this idea that we have this huge trade deficit with China is not true. If you take the profits of U.S. multinationals for the stuff they manufacture in China and sell to the Chinese, it's about 500 billion, which is the amount of the trade. The trade deficit is what's put on a boat. But if you include the goods manufactured in China by U.S. multinationals, there is no trade deficit. But you never hear that in the press. So that's a big part of an element of our research we want to provide, is just saying, hey, there's more facets to that, and that data is from the U.S. From the New York Federal Reserve. It's not from us.
Now that's really useful. So if people want diversified risk, they can get KWEB with that ticker KWEB in their brokerage account. But what I want to talk about is just to last subject here is to go into Alibaba's most recent earnings, because what is going to be the driver? Because really, honestly, if China all of a sudden wanted to get massive equity inflows, probably the number one thing that they could do is buy Alibaba shares and drive the price up 50%, because then all the indices would go up, and then opinion follows trend, and all the pensions would be like, you're underperforming because you have no China exposure, and it would just be like the oil thing in 2000. I'm not saying they're going to do that like the Japanese did, but they are in the market buying some equities. Leaving that aside, let's talk realistically about the pluses and minuses, because to some degree, the health of China equities is dependent on Alibaba, because that's what Westerners know. Yes, you have Tencent. Speaking about outs, we had the cloud, we had the retail, even Freshippo, that thing could become the Costco of China. I mean, it's not there yet. It's a couple $1 billion business, but so we talked about the new buyers coming in. They also announced something called, they're going to copy Tencent and Pinduoduo in doing the 0.6% service software software service fee on all transactions. I did a back of the napkin math on that. Revenues last year for Taobao and Tmall were 57 billion. So 60 bips on that is 342 million to the bottom line alone. That starts in September, which is about 14 cents a share, give or take. It's not huge, but it increases the profitability, increases the free cash flow. Now, if they can buy back stocks through the Southbound Connect and not have to issue converts to buy back stocks, that could be a factor. But revenues were anemic. Look, GDP 5%, they only did 4% revenues. That's not great. But cloud business revenues finally reaccelerated to 6% year over year. And their AI product revenue grew at triple digits year over year. So maybe speak a little bit about my thinking about Taobao and Tmall has always been like, okay, Tmu's gotten some share because they're selling like the lowest end, lowest margin stuff at a loss. So they're getting share in a weak economy. But when the economy normalizes and you want higher quality goods, no one can compete with Taobao and Tmall. So it's kind of like a double bite at the apple. As the economy improves, the stock does better. But as the economy, the business also starts to do materially better because Temu's not really competing with them as aggressively in those areas that they're entrenched for over a decade. Maybe speak to your thoughts on Alibaba's Taobao Tmall business and then maybe their cloud business and future prospects.
Yeah, I think the e-commerce, which was 15 of the 36 billion in the latest quarter revenue, that's geared to China's domestic consumption story. About 26% of all retail sales happens online. And I think what we've seen, what's weighed on that business is you have this, I call it scar tissue from zero COVID, that what happened in China was different than here. And so coming out of that, consumers have been very conservative. And then you also have a decline in real estate prices in China. And that's upwards of 2/3 of urban household wealth in China is invested in housing. And so as they've seen prices for the first time in their life have actually fallen. The consumer, they're being a little bit more conservative. I thought there was a interesting quote from Alibaba's rival Tencent, that their chief strategy officer had an interesting quote where he said, we've seen the government actually rolling out very proactive policies to encourage consumption. That at some point the consumer sentiment as well as the economy will start turning, and that it's not that people don't have money. People actually have money, but they chose rather not to spend it. And government policies can induce more confidence among the consumer and start revitalizing parts of the economy. So anyway, I think I like that quote. It's from a senior person at Tencent, but it speaks to what's coming for Alibaba. And so Alibaba, when the domestic consumption pie was just growing, when you've got newer competitors like Pinduoduo or JD.com, which historically has been willing to really drop their margins to discount.
Yeah.
You've got ByteDance, TikTok in China. So part of the issue for Alibaba is when the pie stopped growing.
Yeah.
Started materially losing some market share. So my hope, our belief is that as the pie starts growing again, it helps insulate Alibaba besides the moves they're making to head off some of these competitive threats. At the same time, I do agree, Tom, that part of what gets us excited about this is the growth in cloud, the non-China e-commerce business, which grew 32%. And then you've got their logistics business is doing great, grew 16%. So that's where, the aggregate revenue for the company grew 6%, even though that e-commerce they're becoming less dependent on over time, has had some challenges. So we kind of envision that the other parts of the business start taking up more of the slack, and certainly Alibaba is benefiting from, kind of policies that the Chinese government has implemented in Southeast Asia, in Africa, in the Middle East, in terms of building relationships, this kind of Belt and Road.
Yeah.
China is a benefit. Alibaba is a beneficiary of that. I mean, there's not, so that, as these governments do more, the president of Vietnam is in China today. Like, do you think Alibaba benefits from that? You bet. Not through subsidies or anything. It's just more of, as these countries do trade deals, it opens up the way for Alibaba doing incredible business in Turkey, getting into Europe. Anyway, so yeah, it's actually, it's almost the irony of some of the tariff talk where, man, don't you see how inflationary that is for the U.S. consumers? And here's where you can point to, China exports deflation, and anyway, so there's other elements of the business that have us excited. They've just historically been really overshadowed by this core e-commerce, but we are more constructive going forward.
Yeah,
it's all the buybacks and dividends.
Yeah, and I think as it's interesting, it's like the chip bans were the worst thing that we could do from a national security standpoint, because what we have ultimately forced the Chinese to do is create competency themselves. And all that means is you take some of the best people from our companies, you offer them 4 times the pay, and you basically get all the intellectual property transfer. Whereas when we were just willing to sell them and make them dependent on our drug, which was semiconductors, they weren't as urgently innovating and figuring out a way to do it themselves. And I think in some sense, the weakness in the China's economy has forced companies like Alibaba to aggressively grow internationally. So all these things are going to hit, all the cylinders are going to hit all at once. They didn't have the cylinders of Trindle in Turkey and Lazada and all these other, and they've grown really fast in the Middle East and in Europe. That probably would be less of a possibility if China was, growing the way it was. So as it returns, it's going to be like everything all at once.
Yeah, I mean, I think it's every investor in Apple should recognize the checkers and not chess strategy of policy toward Huawei, where this and their telecommunication business. I have no idea if they were spying, or they clearly engaged in corporate espionage in the past. I mean, without question. But they also, when the U.S. government decided Huawei should pay for those sins in the past by cutting them off, the company had 2 choices: either you go bankrupt or you innovate. And that's created the #1 competitive threat to Apple, where they chose to innovate, and they created this thing called the Huawei ProMate 60 Plus, which is arguably a better phone than an iPhone.
Wow.
And it's not some cheap knockoff.
Right.
It's expensive, but it's arguably a better phone. I mean, just flat out, it's a better phone. And that has become a real problem for Apple in terms of iPhone sales in China. But additionally, similar to what to your points on Alibaba with Lazada and Huawei, they're not going to be allowed to sell them here, but you bet they're selling them in Latin America, in the Middle East, across Asia, because it's a great phone. Yeah.
So it goes to show you don't mess with the free markets. A couple other things I wanted to highlight here. Cloud's adjusted EBITDA increased 155%. And he said, quote, "We're observing strong and sustained demand for AI products and solutions from our customers. Continues to strengthen market leadership." So Cloud had been a drag because they were unwinding the TikTok business, which was the largest customer.
Yep.
And then they were cutting out, shifting the business, public and private, trying to get out the unprofitable business. Can you speak at all about either allaying fears or talking about public and private cloud and how Alibaba can maintain its hegemony in the space. I think they've got 38 to 41% share at the moment.
Yeah, I think in general, some of the diplomatic falling out where you can argue the US and China kind of went through a COVID divorce, they're COVID babies, and there's some signs of that's improving. Panda's diplomacy, and just this week, PBOC met with US Treasury officials, and but anyway, but there is a consequence, and unfortunately for US cloud, they're going to lose those China customers if it's AWS or Microsoft, Oracle, and that will stay in house. Now in general, there's been encouragement from the government for state-owned enterprises and other private companies in China to leverage the technological capabilities of companies like Alibaba, Tencent, and Baidu, who invested in kind of all the buzzwords: AI, cloud, big data, that they have a technological know-how, and then if because of some of this diplomatic fallout, you're not going to be comfortable giving that to a US company, and vice versa, then it's going to stay in China. So now the issue that what's interesting is people say, oh well, that's you're preordaining Alibaba. No, like, these companies in China compete with one another like nothing else. And so I think you have this race to garner market share that's weighed on some of the margins in cloud. But that will sort itself out, right? It'll find a balancing. If anything, you're seeing some signs in the electrical vehicle space where there's no barriers to entry. You've got Xiaomi, which makes cell phones, creating an EV, like how to, but so that competitiveness in China, I think you're seeing the government say, whoa, solar capacity, EV capacity, and I think that will happen in cloud and in actually in technology, where you'll say, hey, listen, you can't let these Pyrrhic victories take place. So I think the market is still finding its way in terms of pricing, but ultimately Alibaba is really, really well positioned and will be one of the winners there.
Yeah, no question. And another thing that people are going to have some worry about is the free cash flow. Okay, so they generated 4.6 billion cash from operations, 2.3 billion of free cash flow. That's down materially, but they've identified two key reasons for that, and maybe you want to speak to a little bit about that. First was increased investments into Alibaba cloud infrastructure. So what they're saying is our demand is so strong that, quote, as soon as we get a server up, a server is instantly running at full capacity. That's the kind of demand. So we can expect to see a very high ROI over these next few quarters, because we're building compute power to meet existing demand, and that new compute power coming online is getting instantly taken up and running at full capacity on day one. So they could either not invest and have $5 billion of free cash flow, or invest and in kind of the gold rush days of AI cloud and gain share and keep their hegemony, which is what they've chosen to do. But the other thing that impacted free cash flow, because we emphasize that on our podcast a lot when we're doing turnarounds, we do a lot of turnaround situations. Baba is one. And the CFO said, quote, your second question is about free cash flow. As I explained, there's quite a big significant drop of free cash flow. One of the reasons is the significant increase in expenditure to AI investments. The other reason is because of sort of the working capital changes in relation to some of the business scale jobs. What they did, which also hurt the Taobao Tmall, was they're reducing that direct sales business. I don't know if you're familiar with, but that was down materially. They're proactively doing that because I guess it was low margin. And he goes, if you look at the business scale jobs, many of them, the majority are from those planned scale down, if you like. As I was explaining why our direct sales business within Taobao and Tmall dropped quite significantly. The reason is we proactively scaled out some of these 1P business in Taobao and Tmall. We believe in some of these business categories, 1P format probably not a more efficient format. So that's sort of practice. But if you, but you will also have some of the business scale job was not proactively did that. Some of that overall market situation, the revenue dropped, for example, from Sana, like In Time, all those businesses are 1P, and the job of their scale actually impacts working capital. I don't know, I can probably give you a bit more color on, because the 1P, on the other hand, you're buying inventory from a vendor. On the other hand, you sell it. And does the vendor normally give you a credit term like 60 days or 90 days? If you can make your money, your inventory turn over, i.e. sell inventory within a short period of time, shorter than the short-term credit you're given, actually you are generating cash flow, particularly if the size is going up, you're generating positive cash flow. So on the contrary, if you're reducing scale, in this case on purpose, it will have outflow on the working capital. But is that a permanent impact? He's asking a rhetorical question, and he says, to me, I think that is relatively temporary impact. So this process of reducing sale in that direct sales business, we see this type of outflow, but when the business becomes stable, we will no longer see these types of outflows. So for everyone worried about free cash flow and is the business deteriorating, it's not. It's one, it's proactive decision on investment. And number two, taking down this business, this undesirable business, the direct sales business for them, is impacting working capital, which is what it is impacting free cash flow. And you can see that partially evidenced in cash from operations still being $4.6 billion and then buying back $5.8 billion of stock. So I think that's kind of the key highlights. It's good to see the AI revenues up 200%. It's good to get that explanation. And then Eddie Wu, the CEO, proclaimed that they're going to return to double-digit revenue growth in the second half of the fiscal year with gradual acceleration thereafter. That's huge, because no one is predicting that China GDP is going to go up to 8% or 9%. So he's saying we're going to go from underperforming GDP in Taobao and Tmall to dramatically outperforming GDP as the monster player. And then the final thing, I'd say two things that I liked about getting the cash under control. First thing was, this was a real pet peeve of mine. So they bought $5.8 billion of stock, but it was a net reduction of 2.3% of the share count, because they've been doing a lot of employee stock options, employee stock plan, and which you said when meeting with these people, they were really motivated to get the stock price up because they all have a ton of stock. What I'm glad about is that starting last quarter, they started to replace a portion of Alibaba's ESOP incentives with long-term cash incentives for our employees starting last quarter. These cash incentives will be reflected as costs. And this is huge as an owner. There are going to be less shares, less slices of the pie given out, and they'll have that cash restricted over time. Cash is a one-time pay. Slice of the pie is a forever pay, which as an owner, I'm less inclined. And then finally, they cut 6,700 jobs, which it's good to see them taking a little bureaucracy out of the business as well. So all in, I mean, this thing looks primed and poised to, and when it turns abruptly. Whether the catalyst will be some policy from the Chinese government, or this 20 billion to 30 billion of new buyers, or the weakening dollar, or the actual change in Fed policy where we've seen historically dollar goes down, yuan starts to appreciate, bond yields, Chinese bond yields start to go up, a yen starts to go up, and all of these things click all at once. But my experience in just looking at the history is, while they take a long time to turn, and 2.5 years is a long time by historical standards, kind of in line, when they do turn, it is so abrupt and material. And maybe you could just speak to that and any of the other points that I made on Alibaba as we wrap up.
No, it's you do incredible service to your subscribers and listeners, just your depth of analysis. And I mean, and in general, I mean, I think you've had a little bit of an unwind in terms of China allocations. I think there's a geographical that, a lot of US investors went underweight or exited or were neutral because of Trump with the trade war became the tech war, and then zero COVID. Some of the internet regulation and a lot of European investors really got hurt when Russia invaded the Ukraine because they were very overweight Russia, and they said, "Wow, if China were, Russia was overweight, but it was a small position. If China ever invaded Taiwan, that's a big position." Within Asia, I think a lot of those investors were slower in coming out because obviously it's an important regionally, economically, but even going there. So they were slower to come out. And then actually, I think investors in China were really the last to come out because they'd say, I'm still using Alibaba, or the world's not ending. And so that led to a real capitulation in January of this year, where the Chinese markets really rolled down because there were literally no buyers. And then there's other factors. Actively managed funds have really suffered from the flows in the passive funds. So there's no dip buyers left.
Yeah.
And ETFs are there's a momentum element, you could argue. And so, we think the rewind will happen in reverse, which the Chinese will buy China.
Yeah.
And you're actually seeing that through this southbound stock connect, Chinese investors have bought more stock and ETFs year to date than in all of 2023.
Wow.
Just about $45 billion. And so in Asia, I think the view is, well, if that yen starts appreciating, that's a problem to being overweight Japan, right? That could actually. And then India, to your point, Tom, we do think it's professional investors are going underweight because of the valuations. It's a very retail driven market. It's actually the largest derivative market in Asia. People talk about, in the US, everyone makes fun of this ODTE US, but in check it out in India, huge options derivative market. And when you sort for the largest derivative positions in India, you got to go way down until you hit the first put.
Wow.
It's all calls.
Wow.
That's part of what's, this retail enthusiasm, because their economy is doing well and Modi. Yep. But there is this ODTE effect. I mean, they don't have ODTE options, but so anyway, so a lot of professional investors are saying, hey, maybe I should be a little nervous about India. And so I think over time, I think a lot of, as well as the other big overweight in Asia, is US equities. I mean, it just, I really do think a lot of this money is retail money out of Asia, and the dollar declines. That's going to weigh on, if you're levered up, it doesn't take much until you get really hurt, as we saw with the yen carry trade. But I think either elements of that start flowing back. I mean, that's been my counsel to people, is like, hey, like, I'm not, I'd be charging 2 and 20 if I could predict the future, right? But why would you not take a piece of US tech profit and put in cheap China?
Yeah.
Cheap China tech. Like, why? Like, just take a little smidge. Like, why would you not? Particularly, with the election. What are based on who wins? What happens with long-term cap gains? Like, there's all these different scenarios. Like, why wouldn't you just take a piece? Sell high and buy low. Like, why would you not do that?
Yeah,
just for a piece, right? And I think there's an argument we're starting to see that. Yeah,
and it's it's the old saying: good things happen when you buy high quality assets at low prices. I mean, it's just a matter of it's never a question of if, it's a question of when, and the same will be true. I love that you brought up that energy analogy in 2020, because it was that same level of pessimism that pensions will never again invest in it until the price goes up and everyone chases it. And I could certainly see, I mean, Mag 7, their earnings growth decelerating from 50% to 20% doesn't mean they're going to crash like the tech wreck. They're just going to, I think, perform less well than they have in the rearview mirror. There'll be a lot of money made under the surface, but you can make tons of doubles and triples under the surface, and the indices don't do much. And that would imply that the Mag 7, maybe they get back up to highs and they just grind for a year, and as the dollar weakens, we start to see this diversification. So I'm very excited. One of the things I like to look at every day when I wake up is your writing on ChinaLastNight.com. So maybe if you could tell people how to follow you, where you are on Twitter, tell them a little bit about your daily China note, and lastly your ETF, and then we'll wrap up.
Yeah, no,
and any final thoughts also? Yeah.
I mean, our such a key thesis at CraneShares is providing a data-driven perspective on what's happening in China's economy and capital markets. And, in order to do so, I write, I've been doing it for, I think like 7 years. ChinaLastNight.com, which is just a brief, concise overview of what happened last night in China, what's important. And I use it as an element to maybe negate, some of the popular Western headlines that are not necessarily data driven. I jokingly say no one should read it. Not even my mom reads it every day. But if you subscribe and it's free, it's there when something happens and you're like, oh, like what, why is the market up or down? You'd be like, oh, okay, like here's China last night. And so, yeah. And then on Twitter, I do put out, when available, at Ahern, AHERN_Brendan, at Twitter. But then of course at CraneShares.com, we have research on the ETFs, as well as CraneShares is our Twitter handle. So but the whole point is like, you like what you do, Tom. You provide great research, and you earn the trust of investors, and that's been our playbook going back to 2013. Is just we just want to be a resource and try to do. We can't solve markets. I wish I had that ability, but no, we're very constructive, and I think there's market leadership regime change is a super tanker, and it doesn't happen overnight. There's no it's not like the Krispy Kreme sign going off. No, it's not that easy. It's slow, but I think there's a huge home bias to U.S. equities. But I think it is a global bias to U.S. equities. And I would argue that there's some real arguments that's changing. And I think great companies in China, including Alibaba, they're putting, really their wallet where their mouth is. And, if these tech entrepreneurs are buying back stock, that probably means China's economy is not to do a Thelma and Louise and go off a cliff.
Yeah. That
their own company's prospect, like Alibaba, is not about to go off a cliff, that they see something and they're doing something about it. And the question is like, what are we as investors doing when we see that? And I'd say, like, listen, this stuff is volatile. I mean, it's part of a well-diversified portfolio. These stocks, these ETFs, 2 to 3 times more volatile than the S&P 500. So you just got to volatility adjust your position. But yeah, we're constructive. We see an opportunity. I mean, that's self-serving and highly biased. I mean, that's the asterisk.
Yeah. Well,
look, very heavily invested personally, and it's been a brutal, really 3.5 years. But I think these things do pass for sure.
Yeah, well, I think we've wrung out a lot of the downside volatility, and it'll be fun to experience the upside volatility when it finally turns. So, want to thank you. And one last thing I would just say is that one of the guys that I admire quite a bit, obviously I'm a Buffett acolyte and Munger and all those guys, but another one that's more along the lines of my style is David Tepper. And he just wrote $1 billion check to buy some Alibaba in the last quarter. last couple of quarters. So,
Michael Burry, another value guy.
Another value guy, but a guy with, some dramatic outperformance over decades, 30% CAGR over many decades.
Tupper's a legend.
And what I love about, what I wish we saw more with American companies, when American companies stock craters, management don't buy in stock the way that they do in China. And I love the fact that the Chinese have the right mindset that when the price goes down and you believe in your prospects, that's when you load the boat and you buy all the stock. You don't crawl under the desk. And I think that's going to serve us as owners very, very well, that they were reducing the float. And in Baba's case now, even doing it more aggressively and saying, you guys have enough pieces of the pie. We're going to give you cash bonuses and we're going to let the owners take the ride with us. So get on before we take off.
Yeah. And, at year end, I think Joe Tsai and Jack Ma, who's retired from the, made a big purchase. I forget what the exact numbers, but just a very solid sign all in, altogether.
Yeah, and they're turning the boat. Well, with that said, thank you so much for your time. I know we're going to get out on the link soon together, and we'll hope everyone enjoys this.
No, thank you so much for the opportunity, Tom.
All right. And we're back. So now we're going to shift gears over to wasn't that incredible, by the way? Now we're going to shift gears to our normal scheduled programming. We got a super amount of value this week for you. So those of you on vacation, you're missing out, I got to tell you. But starting with the quote of the week, we've got 2. Warren Buffett, look at market fluctuations as your friend rather than your enemy. Profit from folly rather than participate in it. And the second one is, I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. That's both from Warren Buffett. That's a good context. And as always, my favorite mug. Hedge fund tips on one side. Opinions, not advice. C terms on the other side. So from my friends out in Dallas. So go up here and click on terms. Also, we're going to be hiring a new video editor to do all the social stuff that we post on LinkedIn and Twitter and TikTok and everything else. We got 2 fantastic candidates. I've said that we've narrowed out that those, and they've been qualified because both of them have listened to the podcast for 2 years or more. So they know the context. They know, they're schooled in it. It's not just people that can cut videos. It's people that can think and understand how I think. So both of you that I've emailed, send me the information that I've sent. I will be in touch with you early next week, and I'll make a final decision sometime mid next week. If we are short on videos in the meantime, guys, just deal with it. It's we got to find the right person that really understands it and has been with us for a while. So excited to go through that process. If you still haven't applied, go to my Twitter feed, scroll down to the video. It explains how to apply and what I'm looking for. Our article of the week, we covered a lot of this with Brendan. So just want to cover a few critically key points and reemphasize so everyone understands what's going on. First and foremost, buybacks through the roof. You can see it here. This is interesting from Goldman Sachs. I referenced Fastlane and the checkout system that increases conversion from 50% to 80%. Well, just a couple of days after, PayPal announced a partnership with Ahern, which is a huge payments processor in Europe, to offer Fastlane. And here's what Goldman Sachs had to say about it. Ahern offering Fastlane to its enterprise merchant and marketplace customers. Fastlane allows first-time users to save their card and shipping information, then automatically pre-fills these fields at merchants using Fastlane for all future purchases. This improves guest checkout conversion rate to 80+% and reduces time to checkout by 32%. We view the announcement as a positive development for PayPal as distribution for Fastlane expands, particularly if offered via Adyen, which has strong global enterprise relationships. In particular, We believe the distribution of Fastlane through channels similar to branded checkout and other payment methods shows increased ability to compete versus other methods of online checkout. We also see this as consistent with management's commentary around the potential to unbundle Fastlane from branded and unbranded checkout, which we believe helps PayPal to compete on a more similar playing field to Apple Pay and Google Pay. We see this as a positive for PayPal's distribution and continued signs of the strong execution at the company since the current management team took the helm, i.e. Alex Chris, who came from Intuit, who ran 50% of the business, while over 10 years the stock was a 38 bagger. So we're excited about that. We covered Charles. This is critically important. You will understand the significance of the chart below after you listen to my conversation with Charles Payne, and which you just did, and read the article from last week. Here's the link to the article from last week. This, by the way, not only goes into our updates last week, but it has links back to our original theses when we got involved in the company in May of 2022 at $5.10. So per share. You will understand as it relates to vehicle incentives. One of our loyal podcast, VideoCast viewers, hat tip to Stephen Frampton, sent us this updated chart from Cox Automotive, and then I've made these annotations on it. And here's what we've been saying. People have been worried. Oh my gosh, dealer inventories are growing. They're increasing incentives. Increasing incentives are the name of the game when you want volume. We are not in the business of Ford and GM making as much money per car as possible. We are in the business of Ford and GM making as many cars as possible. That is the critical name of the game. And so right now, vehicle incentives are at 7% of total purchase price. In 2017, they got up to 11% of total purchase price, and average incentives in July rose to 7%, or $3,383 per car, up from 6.4% in June, and the most generous level seen in 2024. Incentives are now higher by 59.1% compared to 1 year ago, when the average incentive package was 4.4% of total purchase price. In July of 2023, new vehicle incentives in July were at their highest point in more than 3 years. This is huge. This is going to show us big volumes because, like I said, the cartel that GM and Ford and Stellantis had during COVID, when they could control supply and charge as much as humanly possible per car, is over. Okay, and now, you know, the Koreans are putting in cheaper cars, and they're going to have to make smaller cars, massive volume, and CPS gets paid per car, and it's pretty much the same amount of parts per car, except for the fact if you go to hybrids, it dramatically increases the cost per vehicle for Cooper Standard. In other words, hybrids are even better than internal combustion, and EVs as well, which are slowing demand. But where they make the biggest amount of money is the hybrids. ICEs are good, EVs are good, but I think demand is waning for EVs. All right, Alibaba update. So we covered with Brendan this $20 billion coming in. They had a shareholder vote today. I'm sure there'll be an announcement tomorrow. I'm sure that went through, in which case the southbound link opens, which could be as early as September 9th. We were talking about $20 billion of flows. Brendan referenced maybe 30 or 40 billion of inflows, which would be 20% of the float, which would be absolutely unbelievable. But I think that's true. Like, if you've got, if you weren't allowed to own Amazon for all these years and you have 3 boxes a day coming to your door and you're, buying books and Audibles and watching their videos and a Prime member subscriber, and all of a sudden you have the chance to participate in that and buy it, you're going to buy it hand over fist. And I think the Chinese, it's the national champion. I think it's going to be, oversubscribed, so to speak, in terms of demand. So that's that. They went through the historic stuff here. The next plan, the vote is today, and then Stock Connect on September 9th. You can see in the Bloomberg article. Also, we covered with Brendan the 60 basis points on Tmall and Taobao transactions, which is in line with their competitors. JD and Pinduoduo has been doing it for a while. They're now going to get that. That's $343 million to the bottom line, and more. That's on last year's sales. So prospectively, it starts in September. That's straight to the bottom line. And then even the sell side got excited after earnings. Bank of America came out talking about profit. Let's see. Reiterate buy on improving growth outlook. Solid investor return execution. Profit beats consensus as enhanced cost disciplines across the business. And then they go through the growth and the expectations, etc. So the key highlights here, we covered quite a few of them. The total revenues are up 4%. Cloud business grew 6%. Cloud adjusted EBITDA up 135%. AI revenues grew triple digit year on year. Paying users of Alibaba AI stuff 200% quarter on quarter. International grew 32%. Kai now grew 16%. They repurchased $5.8 billion of stock, reduced the float by 2.3%. That's going to get better and better because now they're shifting from all stock incentives to now cash, which I've been pounding the table on for a year. Why are they giving away so much stock? So now they're going to do cash. I love cash. Bonuses restricted over time because cash is a one-time payment. A slice of the pie is a forever payment. I'd rather give them a one-time payment versus a forever payment. They've got enough stock. They have the same incentives we have as co-owners. They cut 6,700 jobs, so they're showing discipline. And for the free cash flow, which we're going to reiterate, we covered with Brendan, people were worried about that. They still did $4.6 billion from operations. They did $2.3 billion of free cash flow. That was attributable to two things, just to re-emphasize. I'm not going to read the quote again, but working capital as it related to proactively taking down the direct sales business at Taobao Tmall. And by the way, that noise in the background, they're cutting a bunch of trees on the property. So we'll just deal with it. So that was one. And number two, investment in AI cloud because they can't keep up with demand. So they got to build new servers, new data centers because the compute demand is literally unlimited and they're the number one player. So all they have to do is suck in all these people now at low margins. And then once they've dominated everything, then they can raise price. Once everyone's stuck on their stuff, the switching costs are higher than you think. It's a pain in the ass if you're a CTO. You don't want to switch if you don't have to. So inertia is the name of the game. Internal and external e-commerce market share. This is key. So internal and external data about e-commerce players' market share dynamics indicates a positive trend in gradual market share stabilization. So they stopped losing share and they're actually starting to regain share is what they said in the Q&A section. Also, their CMR growth, the GM, gross merchandise volume growth grew double digits. The CMR growth, the margin on that didn't grow as fast because obviously they're now boxing out Temu and Pinduoduo. They're bigger, they're better, they're stronger. They're going to kick them in the teeth. The economy is going to recover, and then the higher end stuff which they own is going to dominate. But in the meantime, they're like, we're going to even kick them where we don't play, and we're going to go after them in the low end, low quality stuff, and we're going to do that for a while, which they did, and that impacted their CMR. But they expect that to catch up to gross merchandise value very, very quickly because they had to move fast, which they did, and now they're caught up, and the margins are going to go back. So we're confident that Alibaba's overall revenue, excluding Alibaba consolidated subsidiaries, will return to double-digit growth in the second half of the fiscal year with gradual acceleration thereafter. They still have $26.1 billion remaining on the share repurchase availability. And as we've covered with Brendan, he believes what we believe. that they will no longer be limited in their ability to do buybacks because they can't get they can't get their cash outside of China. Now they'll be able to buy on the southbound connect, and so they won't have to issue these convertible preferreds and then buy them back to be anti-dilutive, so they can get cash out of the country, cash. They can now just buy stock on the southbound stock connect once that goes through, and that's going to enable them to do unlimited buybacks to the extent that they want versus limited to the extent that they can access cash. Even though they have unlimited amounts of cash in China, they had trouble with the amount of cash they had outside of China. That's no longer going to be an issue. Quote, we've started to replace a portion of Alibaba's ESOP incentives with long-term cash incentives for our employees starting last quarter. These cash incentives will be reflected as costs. While it will change comp and lower adjusted EBITDA, it will also result in less ESOP dilution in the future. That is huge, ladies and gentlemen. Also, as far as Alibaba Cloud, we are confident that revenue from external customers will return to double-digit growth in the second half of the fiscal year with gradual acceleration thereafter. This is becoming a growth company again, ladies and gentlemen, and it's priced like a cigar butt. And that's going to change, and when it changes and re-rates, it's going to be very, very quick. Expecting double-digit revenue in cloud, accelerate moving forward. The other thing is the analysts are like, aren't you seeing a slowdown? Quote, what we see certainly among our own cloud customers is that their AI budgets for this year are higher, significantly higher than they were last year. Any enterprise that is digitized and relies on digitization must be investing. It has to be investing in AI. All the industry is now that are using AI are leveraging it to enhance their competitiveness and efficiency. So any enterprise that's in any way digitally reliant will certainly not scale down its investment in AI, because to do so would impair their own competitiveness and efficiency. So that's a clear trend we're seeing, and we are not seeing any kind of slowdown or softening. This was a key reason we got involved with Alibaba to start with, is their cloud hegemony. Why the CFO sees free cash flow decline as temporary, which we covered. So he's basically saying, let me explain this. It bears such important repeating as it relates to free cash flow. Okay. Because for doing 1P business, on the one hand, you are buying inventory from the vendor. On the other hand, you sell it. And does the vendor normally give you a credit term like 60 days or 90 days? If you can make the inventory turnover, i.e. sell inventory within a short period of time, shorter than the short sort of credit term you're given, actually you are generating cash flow. Particularly if the size is going up, you're generating positive cash flow. On the contrary, if you're reducing scale like they are with the direct sales business on purpose, you will have outflow on working capital. But is that a temporary impact? To me, I think this is relatively, he says, is this a permanent impact? To me, I think this is a relatively temporary impact. During the process of reducing scale, we will see this outflow, but when the business size becomes stable, we will no longer see these types of outflow. Okay. So why are they doing the CapEx? That was the second thing that impacted free cash flow. And it's simply because, quote, we see a lot of demand, a lot of unmet demand from many clients. This is related to AI CapEx. And you look at the pipeline those clients have, you know there's going to be ongoing demand. So whether it's training, inference, or API calls, what we see, we're making these kind of CapEx investments. Quote, as soon as we get a server up, a server is instantly running at full capacity. There's that kind of demand. So we can expect to see a very high ROI over these next quarters because we're building compute power to meet existing demand, and that new compute power coming online is getting instantly taken up and running at full capacity on day one. Huge, ladies and gentlemen. So high single-digit GMV growth, double-digit order growth this quarter. Some of the other we covered most of them. I just want to get some of these stars here. You can read this on your own. The 88 VIP members, that's like a paid subscription like Prime, increased double digits year over year, surpassing 42 million during the quarter. Pretty serious. No one ever talks about it. Number of paying users using Alibaba's cloud AI platform has increased by over 200% quarter on quarter. It's unbelievable. Driven by double-digit Cloud grew 6%, driven by double-digit public cloud growth, increasing adoption of AI-related products. AI-related product revenue continued to grow at triple digits year over year. We continue to invest in customers and technology, particularly AI infrastructure, to increase cloud adoption and for the AI to maintain our market share leadership. Significant double-digit revenue. Okay, so we covered that. AIDC, that's the international, grew 32% year over year. Cainiao, the logistics, 16% year over year. Local services group, 12% year over year. Even the digital media grew 4% year over year. All right, let's see here some of these key stars, and then we can move on. We've got still a lot to cover this week. I was going to release Brendan's interview separately, but then I just thought it would be confusing, so we put it all in here. Okay, Alibaba Cloud has gained notable recognition as the cloud service provider of choice for AI. According to recently released Gartner, which is the industry standard, Magic Quadrant for Data Science and Machine Learning Platforms report, Alibaba Cloud has been mentioned as the only Asia-based cloud service provider among global players. Co-generated while enhancing service to 27 languages. Number of paying users on Alibaba Cloud AI platform increased over 200%. We covered all this, covered this, covered that. Okay. Our focus on enhancing user experience by offering quality products at attractive prices with great service led to stabilizing market share of Taobao and Tmall Group as we return the business to the growth trajectory. The cloud business achieved positive revenue momentum driven by public cloud and AI-related products. We continue to invest to maintain our market leadership. We invest for growth in our core business while reducing losses in other business through operating efficiency, which they did a good job. That's why the sell side was so happy. 5.8 billion of shares repurchases underscores our confidence in business outlook. All right. Okay, next. Increase. Covered that. I just don't want to miss anything because there's so many important points in what happened. Talked about the reversals. Look at these business units, top line, every single one. China Commerce up 1%. The direct sales, they're winding down on purpose, as we discussed. The wholesale up 16%. The overall, if they weren't proactively turning that down, I think it was like mid-single digit growth. Cloud Intelligence up 6%. And then you just go line by line. Every single unit is up. Every single unit is up. That's what we call a turnaround, ladies and gentlemen. That's why turnarounds are so critical. What you need is cash on the balance sheet and or options to pay down debt. They don't have any of those problems, and they're actually reaccelerating. So they're like late stage turnaround. Now they're into growth reacceleration. You can go through all those. Just trying to make sure that I didn't miss any key things I wanted to cover here. We covered a lot of them with Brendan. Still have $84 billion worth of cash, by the way. Net cash, whatever it is, $65 billion. I think they got $20 billion of debt. They culled the employees, which we covered, further stabilization. Triple-digit growth, we covered that. Through intensive R&D investment, we aim to sustain profitable growth while establishing ourselves as a leading cloud provider for AI with healthy profitability and market share leadership. Profit 32% year on year. Okay, so in conclusion, our strategic focus is twofold: enhancing operational efficiency across all business segments, while on the other hand, actively investing in the key markets to drive quality growth and scale with the goal of achieving more substantial profitability at scale in the future. Winning the mind share of our consumers. Purchased 630 million ordinary shares or 77 million ADS for a total of 5.8 billion. 2.3% net reduction. We talked about the long-term cash incentives. This is a big deal. Increasing investment led to better consumer retention, increased the purchase frequency, and positive feedback regarding overall shopping experience. Consolidated. Okay. clouds, we believe, strengthen our market leadership. He's 4%. Okay. Increasing this investment. Okay. AI solutions. All right. So you can go through this line by line. Okay. Now, as the market share stabilizes, what we've certainly seen this quarter, we can start to accelerate the pace of our monetization efforts. That's what that CMR was. The margins, the volumes are growing like crazy. The margins now are going to re-accelerate. They can start to do monetization now that they've stabilized the ship. There are a few factors you'll have to look at. First, the various new products we've launched, including live streaming, including the RMB 10 billion subsidy program, which resulted in higher user return and return to platforms and high user repurchase rates. But it's going to take a bit of time to roll out the new monetization approaches and products for them to gain traction. New advertising product we're introducing. The first being okay. So first they got the traffic. Second, sufficient number of advertising take part. Covered that. They talk about the 60 basis points on all transactions starting in September. That's huge. Hundreds of millions to the bottom line. Go, you're looking at long run AI. Okay, so they're aiming to get the approval from shareholders and get it completed before the end of August, which means the Chinese could be able to start to buy Alibaba stock as soon as early September. So half of their cloud growth is going to be driven by AI products versus the CPU stuff. Investing, certainly, we got that. So there's just so much good detail in here. Secondly, the software service fee will software service fee will also help on the take rate, a few other short measures as well. So these are the things we've currently been. Why we started to do it, because we see growth back on the GMV and we see the sign of stabilizing market share. So they could only charge this if they had confidence that they've started to regain share and they're back on a growth trajectory. You know, you don't raise prices on merchants if you think the ship is sinking. You only do that when you're back to growth, and that's where they are. Okay. I think the reason, clearly see a very strong backlog. Continue investing simply because we see a lot of demand. Okay. We expect to continue to be investing in AI CapEx at the same pace, simply because we see a lot of demand, a lot of unmet demand from many clients, and you look at the pipeline those clients have, you know there's going to be ongoing demand. Okay, we covered that. All right, fear and greed's at 51%, 51 versus, which is neutral despite the huge run-up in the markets. The other thing, though, is the sentiment survey, which is only like 300 people, by the way. AAII sentiment is showing very, very bullish, and bearishes have not gone down. Doesn't mean it has to reverse right away. Our base case has been that we remain strong into early September. Buy the rumor, sell the news on the cut should be the seasonality. So does that mean we sell everything because we know volatility is coming? No. I think what's going to happen is, some of the things we've been doing, like SMTC, we took profits at on the stock was around 75%. And the options were multi-baggers as well. A couple others. C, we took profits on. Some other names that we don't talk about a lot that our clients benefit from, where there's space. So, we are things that have gotten anywhere in the realm of near fully valued in the short term. We've been harvesting cash, either redeploying it, or we'll start to hold some cash as we get closer and closer to that first cut. And then we may put on a couple of tactical shorts, but there's enough cheap, awesome opportunistic stuff in the market right now that we're willing to buy even ahead of volatility, as if we can predict volatility. I mean, we're just going by statistical advantage. And we'll cover some of that in the charts in a second. But No, it doesn't mean this is not a risk on, risk off guessing game. We own quality businesses. We'll ride any volatility through, but if we get a little more strength into early to mid-September, when everyone who's been skeptical the whole way up just starts buying like crazy, that's when we can put on some tactical shorts, maybe raise a little cash, maybe to add some positions that are down, and take advantage. And then after the election, I think we get a year-end rally, as we talked about on some of the segments. So that's that. On the call, we went into how to reach Brendan Ahern on Twitter, his ChinaLastNight.com, and of course his ETF. Next, let's go into the charts. Some of the data we talked about. Now everything is aligned for the Fed. There's no excuse for them not to cut in September. The only question is 25 or 50. Right now the market's pricing in 25, but the CPI came in fine. Rent's a little sticky, but it's rolling over. New vehicle prices coming down. Again, these are the things we want to see. We want to see a race to the bottom in terms of margins for the OEMs, and then flooding the market with volumes. As the incentives come, the people come back. And you can see these different indicators. Interestingly enough, the worldwide box office year to date, ladies and gentlemen, what are the top two films? They're Disney. Inside Out 2, Deadpool and Wolverine was actually the largest R-rated movie box office in the history of box offices. So the idea that no one's going to the movie theaters is apparently inaccurate. Microsoft has accelerated heavy investments in AI. The reason I put this chart is so you can see the magnitude, and you can see why that shift from the Magnificent 7 to 493 is happening and is going to continue to happen. Not because they're going to crash or anything, but because their margins are going to be crimped from all their investment, and their earnings growth is decelerating from 50% to 20%. Doesn't mean it's going out of business. It just means that the relative value is going to be outside those groups in terms of outperformance, and we covered some of that. Bond and equity universe. This is really interesting. The value of all global bonds and stocks is $255 trillion. The value of all global bonds is $130 trillion. The value of all global stocks is $125 trillion. So when you have a company like, Apple or Nvidia get up to these $4 and $5 trillion valuations, when you back it out and you just measure it relative to GDP and measure it relative to the global value of every stock on earth, you can start to see how some of these have gotten a little bit ahead of their skis. And if you zoom out, as we always say, you can discern and take advantage of those opportunities to stay away. So, or trim, as you know, we've done well before any of this yen dislocation and all that stuff was happening. Financial assets are worth 233% of global GDP. They peaked in 2019 at 270 billion, 270% of global GDP. The value of Wall Street relative to the value of Main Street is almost back at record highs. Negative yielding debt has dropped from 18 trillion to 0 in the last 4 years. So there was a lot of negative yielding debt. If you think of JGBs, even real yields on treasuries were negative, and now that's back to more normalized levels. Top 5 stocks in the S&P 500 peaked at 29% of the market in July of 2024. We said it was bananas. That has now rolled over. Magnificent 7 market cap reached a record high of $17 trillion in July 2024, when we were getting out of Amazon, getting out of Google that we bought in October 2022 when no one wanted it. And you can see that rolling over. 17 trillion. Again, you say, wow, $17 trillion. Well, they're great companies. Okay, are they worth 1/5 of the entire world of global equities? Like, there are 10,000 global equities, let's just say. There's probably more. Call it 12,000 global equities. These are, 5 stocks should be 20% of all the value of all of the markets in the world. it's a little extreme, and these extremes always get corrected, as you see, over and over and over. So they get corrected in part by the others growing, and in part by them either staying static or coming in a little bit to more normalized valuations. Tech, telecom, healthcare peaked at 45% of global equities in July 2024. We haven't seen that level since 2000. Okay, so that's where you want to be, where you want to avoid. You got to pay attention to stuff like that. This is the cross asset returns from 2010 to 2024. And the reason I'd like to show this, and boy, you guys are getting a lot of value per dollar this week. I hope you're drinking coffee to keep up with me here. The reason I show these is because what you can see is the last shall be first is a very consistent theme. Just look at gold. Gold was on top in 2010. By 2013, it was at the bottom. By 2016, it was back on top. By 2020, it was way on top. Then it collapsed in 2021. Now it's re-risen. Everyone wants gold. It's going to be back on the bottom in the next few years. No, it can't be on the bottom. Central banks are buying it. Central banks have been the biggest contra-indicator since the beginning of time. So if you just do the opposite, so they'll buy more and then it'll change. Same if you look at these cross-asset returns from in the 2000s. You couldn't give away emerging markets in 2000. By 2003, it was the top performing asset, did 56% that year. The next year, it did 26%. The next year, it did 34%. This is exactly where we are, ladies and gentlemen. We are going to be finding ourselves in a position where they start to outperform. 2 years ago, they did -19, -2. Last 2 years, they're up double digits. They're just getting started. That's what you saw in 2001 and 2002. They came out of the doldrums, and then they made it to the top, which is probably next year. But just look at these patterns. That's the one thing that I'm very good at is pattern recognition. And you look at every single decade. Here was another decade. Everyone says like, oh, U.S. exceptionalism. I agree, U.S. exceptionalism. That doesn't mean that international stocks should underperform forever. And the answer is they didn't. They outperformed in the 80s, believe it or not. Remember, they were down in the Volcker era. Then by 83, 21%, 12%, 25%, 10%, 22%. 40%, 65%. I mean, it was the best performing asset in the 80s. Then the 90s took the break because the tech took over. And then in the 2000s, it had its biggest run ever from 2001 to 2007. So what have we had? We've had the same thing. We had it run in 2000, 2010, take a break due to the tech mania from the last 10 years, and now it'll be back this 10 years. You watch what happens. History doesn't rhyme, but it does repeat. Look at the 70s, what emerging markets did. Top of the shelf every single year. I mean, 14%, 36%, 30%. In 1973, 13.5%. When the U.S. market collapsed, 26%, it was down 15. Then it was back up, top of the chart. These will be back, ladies and gentlemen. All right, so you get the point. Crowded trades. You can look here too where the dividend yields are by sector. Energy is a big dividend yield. As rates cut, people are going to want dividends. Financials, REITs, utilities have already run up ahead of it. Price to earnings, where are the lowest price to earnings ratios? Energy, financials, REITs, utilities. Trailing price to earnings, price to book ratios, etc. So burden yourself with data. That's all I can suggest. It works. The bull bear indicator is not yet at the extreme bullishness level where you want to sell. That's from Bank of America. Restaurant spending is falling a little bit. You're seeing that in the lowest end of the consumer. Retail sales, though, is still strong because in aggregate, people are spending, I think it was like the top 20% does 50%. I don't know. There's so much data. But yes, there are crosswinds. The Fed does need to cut. It's not all roses and green shoots. But if they act quickly enough like they did in 95, all will be well on that front. Here is the S&P forward returns, 13, 26, 30, 9 and 52 weeks after the VIX spikes above 45, which it did a few weeks ago. And you see on average, a year out, it's up 14%. Every period, whether it's 4 week, 8 week, on average, it's up. And that's what we're seeing. Next. Returns were positive when the first rate cut did not precede a recession. And you can see 6 months later. So even if the market goes down a little bit after the first cut, what they're trying to say here is 3 months and 6 months later, on average, it's up pretty materially over time. And if there's no recession, which at 2% GDP growth, it's going to be tough to get 2 quarters of negative GDP. Unless they do something stupid and they don't cut, then you're going to have deflation and a huge problem. But leaving that aside, dividend yield is where the action is at. Inexpensive versus history, the cheapest it's been since 2002. I reemphasize these things because they're important. And if you get the themes, you can make a lot of money. Again, go to hedgefundtips.com. Click on terms. This is all opinion, not advice. We deal exclusively with accredited investors. Talk to your financial advisor. Don't do anything. Don't make any decisions. Don't take any actions. All right, advantage dissipating. So here is the earnings growth that we continue to emphasize with the magnificent 7 earnings growth from 34% to 29 to 18, and then the unmagnificent 493 from negative 4% in 2023 to plus 6.5% this year to 13.5% next year. And then look at small caps. This is awesome. 2023, negative 12.2%. This year, plus 7.3%. Next year, plus 37.6%. So if you're skeptical about small caps because they had a little sell down because of the yen nonsense, you're going to miss the boat, ladies and gentlemen. It's going to move bigly in our view. Small size factor is historically cheap versus large size factor. Growth versus value, expensive on a book value basis. You can see growth is obscenely. It's more expensive than it was at the tech wreck peak. Value versus growth valuations remain well below historic average. Housing starts, that's a function of rates. Philadelphia Fed manufacturing, that was weak. That's why the Fed needs to move. Buying conditions. UK retail sales are re-accelerating. That's been a core part of our theme of the UK getting back on track. S&P historical performance post Jackson Hole, so they speak tomorrow. And the only time they screwed it up was in 2022. Last year they got it right. 2020, that was a strange year. So on balance, it tends to go up, this yellow line. Next is the Fed balance sheet. It's come down quite a bit. That's almost $2 trillion. That's pretty good. This is probably where they'll end. They're not going to be able to reduce a lot more this cycle, but they did better than most people would expect without causing a recession. Expectation of losing one's job at a record high in New York Fed survey. So that's that. So, people are on edge. Fed needs to fix that in the next few weeks. Long-term inflation expectations at lowest since early 2022. That's another thing that gives them cover. Earnings growth by sector, that's for this year. Comm services and tech were the highest. Energy was the lowest. Next year is expected to be healthcare, tech, materials coming back from the dead, from negative to positive. So there might be some opportunity in materials. We like Albemarle, ALB, tiny position starting there where there's space. Not a huge position, super conviction yet. And then, anyway, we're looking in that space. And then Staples, which is priced huge, is going to have lower. So there's a lot to do. Industrial, 16% earnings growth. There's going to be a lot there. People are starting new businesses at extraordinary rates. You can see here, 420,000 of late. Pricey hedges. Everyone wanted to buy hedges when the stock market was in the hole. 2-year high for demand and price sold to you, and they couldn't get enough at the bottom, and they won't want them at the top. So when we're buying tactical hedges sometime in September, they'll be the cheapest that they've been. No one will want them. Everyone will think it's going straight to the moon, and then they'll come in handy. Q2 had a boost in both VC deal volume and cash raised. So that's rising from the Phoenix rising from the ashes. Pricey issuance. P&C insurance monthly is starting to come down finally, according to these charts. Rents we've covered, they're coming down. Down rounds as a share of all U.S. VC deals are still accelerating. So all those shitty deals done in 2021 with free money, they're down rounding all day long. And startup shutdowns are rising at the fastest pace, rising like crazy. They should. I couldn't believe the crazy you-know-what that was going on back then. I could believe it. I just avoided it. Share buybacks by region. Buybacks are at record highs. That's another support under the market. Portfolio and benchmark weights for the Magnificent for core funds. So core funds are slightly below. Index weight is 32%. Most managers at 22%. So they got smashed in August. We did not. August has been unbelievable. July was great. Japan as the highest debt burden relative to GDP. UK is second. US is fourth. You can look at that table there. Monetary policy viewed as the most restrictive since October 2008. Re-emphasizing this. Why? Because the last time that managers believed that policy was this restrictive, the Fed acted, and it was the bottom of equities. So look at these 4 points. March of 2020, we were one of the few people pounding the table to buy. You can review our Market Watch article. I believe it was March 25th. It's on our website of 2020. We were saying we are buyers in the hole, and it proved to be the bottom 2 days later. Literally, it was unbelievable. And then April 2021, October 2008. You can go through there. A surge in global liquidity is brewing, promising a potential economic upswing. This is a big deal, ladies and gentlemen, and it does support, first off, you got the $30 billion of Fed repurchases. Two, you've got the most amount of central banks easing since the bottoms in 2020, 2009, etc. We've covered some of that data in recent weeks. So this liquidity surge is not something to be taken lightly, which is why we've been bullish like crazy since that fourth quarter of 2022 when everyone was hiding under a rock. And so there you go. And it looks like we've got a lot of runway to go. Capital spending quarterly. So this is what's going to cause the margin compression. Amazon, Microsoft, Alphabet, Meta. When you can visualize and see it at record highs, there's no way they retain margins. And then you see storage capacity in exabytes. The demand is greater than the supply. The same is going to be true for Alibaba in Asia. TSX for the Canadians, the loonie is picking up pace as we've talked about, but the TSX trades at a record discount to the S&P 500, not seen since 2001. I'd be looking for Canadian stocks. I think some of the materials plays and some of the energy plays are going to start to be home runs there. So we've got to start to look at some of the Canadian stuff. TSX is finally out of an earnings recession. You can see here from negative earnings growth to positive. Preliminary payrolls through March. This was the big chart of the week. As we had been telling you, I mean, it's like tomorrow's newspaper today listening to this podcast sometimes. And it's not because we have a crystal ball. It's because we just pay attention to data and recognize patterns consistently. And you can too, after you do it for 20 years. I mean, it just comes naturally after 20 years. I guess golf's the same way. It's like I go out and have a blow up round and then I'm like, oh, wait, I've only been playing 2 years. And I'm like, why aren't I scratch or whatever? And it's just like, no, because you suck, you're new. And, and then the next day you're going to go out and shoot an 81 and, feel better about yourself and keep at it. So that's the way it goes. But after 20 years, I figure I'll be pretty damn good at it. All right. Less robust job growth. If they don't cut bigly in the next few meetings, meaning 50 to 75 basis points before the end of the year, they're just blind or stupid. I think that it's unequivocal. They're going to start easy with the 25 and then accelerate from there as needed and temper. But this was, when I think about how off these numbers were, and it was bothering me because it's also what threw them off when inflation was roaring, because the jobs creation was underreported, and now it's been overreported for the last year by almost 1 million jobs. This is something, and you've seen the rhetoric come out in the last few days from all these Fed officials. Our focus is now on the jobs report, because they're like, wait, there are 1 million jobs less than you report. It's like if a public company reports $20 off, their accounting is off, the stock will sell down 30% if their financials are wrong. This Bureau of Labor can get it wrong 12 months in a row by 1 million jobs, and there's no penalty whatsoever. It's really mind-boggling. The penalty is the Fed's been 300 basis points too restrictive than they should have been had they had the accurate data about the jobs reports. So there you go. Let's move on to our Slumer stuff from RBC. Thanks to my buddy over there. Let me just see if we have any more charts here. Okay. FOMC mentions of inflation are falling off a cliff, of unemployment are rising. So that's their dual mandate kicking in. Revisions suggest more moderate payroll growth. We covered that. Non-farm payroll growth revised down 818,000. This is another chart of median size of new single-family homes. We've talked about this for a year. We said, think Levittown. The houses are going to get smaller. Not everyone needs a starter home that's 6,000 square feet, and that's changing. And then finally here, this is financials. Financials weighting in the S&P 500 was 22% in 2007. All this stuff reverts to the mean. It was at a low of 10% during the 2020 lows when we were pounding the table to buy Wells Fargo. Got a double in that. And then now it's reverting back to norm. But this has a lot of room to run. I know we've trimmed a bunch of our Citi and BAC that we bought during that regional banking crisis and made a really, really nice trade on. But we're looking to find ways to buy it back in. And the reason is, hopefully in September, October, we'll get that chance. And the reason is because the M&A and IPO cycle hasn't even begun. So they're going to make money. They've had, they basically doubled in a short period of time, hit the window, and then buy back down low. And that's what we're going to hope to do. Tech weighting as a percentage of the index. We've covered this. Back to 2000 highs. Yeah, it's not where you want to be. But money market funds, as equities go up, as yields go down, this money has to find a home. And just like it did in 2009, 2010, everyone got into money markets in fear. And then it all came back into the market, and you had 10 more years of a bull run. Developed market government debt as a percentage of, this is U.S. debt to GDP. We've covered this, highest debt to GDP since World War II. How'd they get out of it in World War II? They just let inflation run above trend. If they're smart, they will let inflation run between 2.5% to 4% for the next 5 years, and they act quickly enough, and that's how you can inflate your way out of it. That's how we did it in World War II. We'll get the growth. Why? Because we got 72 millennials at prime working and spending years, average age 34. Similar to China, by the way. That's why they're going to have one more parabolic run. Difference is we have a large generation after our millennials. The Chinese don't. They're toast. 5 more years for China, and then bye-bye. Just like Japan from 85 to 89. Here's the Slumer charts. Just shows the S&P hitting a little resistance here. And then weekly, this shows the September seasonality here. So we had a strong August. Now, the only corollary to this is that during election years, election years are in line with this. It shows strength till mid-September, then end of September is where you get the weakness. Early October, you get weakness, and then you get a recovery in late October into November. I think this year might not be till November till you get election certainty, unless it's just showing positively that one candidate is that far ahead. This rebound looks like it has a little more to go, and we could even hit new highs in September, in late August, September, before we get defensive short term. And what else do we have here? We've got the NASDAQ recovering back. I think that's got some room to go. Mid caps just breaking out. We love that story. We own a lot of mid caps. Small caps just coming off the mat. This is going to be the whole theme for the next 18 months, small caps. This is just getting started. And this is probably going to go from, 16 to 24,800. This probably goes to 3,200 on the Russell at least. From where is it now? 2,000. So, 50+%, 60% over the next 18 months. Which means some of those names are going to be up 3-4x, or Cooper Standard a lot more in our view. Tokyo Stock Exchange collapse. It'll recover. What's going to happen is they realize we can't raise when the Fed is not offsetting the liquidity. So as the Fed starts to cut, the Bank of Japan will go back to hiking, but it will have less of a detriment. It won't have the same shock on the rest of the world. It may have a continued shock on the Japanese equities, but there was nothing there anyway. So, it is what it is. Topics. Okay. Japanese yen. That was such a nice move. Hang Seng looks like it's starting to get going again. So breakout, check back, push up, 10-year yield, all these things that we've been talking about. We, on that day that it got down to 375, it was a Friday, we took profits on TLT. We would look to reload those if this bounced back up in the short term. And looking at some of the things like utilities and everything, I don't know why. I wouldn't be shocked if yields went back up a hair. I can't tell you why. Maybe it's something they say tomorrow. But that would probably be an opportunity to reload on that and win again. But even here, looking at the 10-year yield, it looks like it just wants to have a short-term counterbounce, maybe back up to 418 or something like that. So the utilities will probably get hit on that. Dollar, beautifully, it'll have a counter trend bounce, maybe back up to 103 before it rolls back over. Canadian dollar is starting to come off the mat like we had anticipated. Big move here. Copper probably starts to bounce. China's coming back. And gold, people are going to get enough. So maybe you have a parabolic move to 2,800, suck everyone in, and then just roll it over again. Okay, so now we're doing things a little backwards. Let's cover some of the news stuff because we wanted to get to Brendan first. China's battle of the bonds has supply surge adding X factors, so they're going to issue a ton of bonds. That will be stimulative. Japan's economy bounces back, supporting the case for more rate hikes. That's coming in September after the Fed cuts. Alibaba's long-awaited China stock link may provide timely boost. Here's the article talking about 20+ billion. Alibaba says its math-specific AI model outperforms rivals. Alibaba's long-awaited China stock link may provide timely boost. China, U.S. to set up contact group for cases of financial stress. So they're working together. That's good news, not bad news. This is Brendan's comments on some China government policy last week. Article notes that the release from the third plenum, quote, pledged an incremental tilt towards consumer stimulus in what analysts saw as an official admission that previous toolkit was not working as intended. So they're getting it, and Brendan really covered that well on the conversation we had earlier in the podcast. China may let local governments sell bonds to buy homes. So China regulator asks banks to survey impact of stronger yuan. Remember, we talked about higher bond yields, higher yuan, higher equities. That's coming to a theater near you in China. Chinese e-commerce giants want your business, and U.S. retailers are losing it. U.S. sales by Chinese online platforms could soar to $40 billion in 2024 from $15 billion last year. Obviously, Temu is benefiting, but so is AliExpress. Bigly. Okay, so that's a good thing to see. Number of overseas payment buyers mount plus 30% year on year in the first half for Alibaba. Lululemon CEO Calvin McDonald buys up Disney stock, ladies and gentlemen. Disney stock, the one that is getting zero value for having two of the biggest movies of the year. PayPal, Apple opens up payment options, boosting PayPal stock. This analyst sees long-term positives. The game is on. The turnaround is happening. We love new management stories. Speaking of new management stories, Advance Auto Parts, the guy who ran HD Supply. Advance reported today they sold the Westpac business, which is huge. They got $1.5 billion, 1.2 net of taxes. They're going to pay down debt. Their comp store sales were up year on year. They beat on the top line. They missed a little bit on the bottom line. They took their guidance down for this year, which upset people, but their comp stores rose 0.4% year on year. The guidance was a little weak. The key here is they've taken existential risk off the table by deleveraging the balance sheet. They're holding their core business together and reaccelerating. Earnings will be down a little bit this year. So all I'm telling you, and maybe we'll cover this one in a lot of detail, I can just tell you this. I was busier than a one-armed, well, let's see, there's two. One-armed paper hanger or a one-legged guy in an ass-kicking contest. This morning from 7 to 9 when the stock was down 20%, we nearly doubled our position and brought our basis down to $53, $53 and change per share. I'm just looking at the aggregated portfolio. So wherever there was room. So that tells you everything you need. Does it mean it can't go to 40? It could go to 40. I literally, anyway, the point is it's generating free cash flow. It now does not have existential risk. It's got a great manager in there. So whether it goes to 40 before it goes to 100 or it goes back to 60 before it goes to 100, I could care less. I literally could care less. All today was in the morning was an opportunity to increase my position and bring down my basis in a great business, in a good business with great management. And those are the things you can get doubles and triples in reasonable amounts of time over a handful of years. So less than a handful of years. Also, I have a co-investor named Dan Loeb who has an activist position in Advanced Auto Parts, and he will continue to put the pressure on. But the fact of the matter is, without even going into an hour analyzing the earnings call, which maybe we'll do next week, all I can tell you is he's doing everything he said he was going to do. Sell off Westpac, delever the balance sheet, grow comp store sales, retain his top people, build the inventory so the local garages could get their parts faster than anywhere else. Make sure they didn't have idiots at the counter that didn't know anything about cars. So he's made all those investments, and now you're going to see the turn. Just like PayPal, everyone's like, oh, Alex Chris, he's not going to do it. Well, now he's doing it. And then when it comes all at once. So we love these opportunities. We love the opportunity when we could buy PayPal in the 50s, and now it's in the 70s. So, we do that. And by the way, if you think you can outperform over time without stepping in these aberrational periods of dislocation, good luck. These are manna from heaven. This is where you make your money. When everyone is running out the exit door yelling fire, you run back into the theater and pick up all the purses because that's where the money is made. And I feel deadly sorry. Maybe I won't in a week for the people who sold to me at $48 and $49 this morning. But I can tell you that in 2 years, they'll be really sorry they sold to me. I don't know, in 2 weeks. Maybe they'll be like, you were a bag holder for me. For 2 weeks, I could care less. That's why we run low leverage. I know what I own, and I use these opportunities. Intel's going to be the same story, by the way. We brought our basis down to 23 and change. It's like the government won't let them fail. They're going to have a duopoly. We went through that story last week. So anyway, it's just Christmas time is all I'm saying. United CEO expresses renewed confidence in Boeing after meeting with new leader in Ortberg. I covered that with Charles. 14% of PCs shipped globally in Q2 2024 were AI capable. Who owns that market? Intel owns that market. They're going to ship 40 million AI PCs. As a matter of fact, there's another article we're going to cover where here we go. Intel disappointed investors. For corporate customers, it's still good enough. All the CIOs are like, yeah, We like it. We know what it is. It's worked for 40 years. We're good with Intel. It's fine. And by the way, this is the key story. Walmart allows AI. That's good news for tech stocks. Okay. It's good news for tech stocks. The next story in AI is not NVIDIA, which is going to be effectively a commodity producer in 2 years when Intel starts competing with them and all these other companies start competing with them and the chips become an afterthought. It's the application, and industrial companies start doubling and tripling because they're using AI technology off what will become commodity chips. People think these cycles, it's like they keep happening and people keep getting faked out. It's novel until it's not. And Intel, in the land of the boring, Intel is king. So once this stuff becomes commodity, Intel will have the fabs. Intel will be able to produce the most boring commodity stuff at scale and pick up share and rock and roll, backed by Uncle Sam himself with unlimited pocketbooks to make sure that that happens. So the story is going to be how these applications and companies like Walmart and industrial companies start to benefit materially. Alibaba, Tencent cast wide net for AI upstarts. Since 2023, 40% of Alibaba's deals in China and 30% of Tencent's have targeted AI startups. So we've talked about Alibaba is basically like owning a China AI ETF. And what they're basically saying in this article is that some of these investments are going to be worth so much money. Like, we don't even know what we own. Like, we know why we own Alibaba based on their core businesses and what is price is what we pay, value is what we get. We know we've got a huge bargain. We don't even know what we own. All these free options we have in all these AI startups in China that have to get their compute, that Alibaba got huge equity positions for giving them compute tokens, which basically cost them nothing in their cloud service other than server racks. And 3 years out, a couple of these little baby companies are going to be worth $100 billion, and we're going to find out we own 15% of it and all of this stuff. And that's just going to be whipped cream icing on the cake. So you can read that article. Covered that. Let's see what else we got here. Yes. Disney's Deadpool and Wolverine becomes the highest grossing R-rated film of all time. That franchise is valued at 0 in the market. It's going to be valued at a lot more in a couple of years. Dollar hit years low as traders prepare for rate cuts. You guys knew that was coming a year and a half ago if you've been listening. Fed policymakers flag rate cuts as job market cools. So now they're shifting the focus. Oh, this is interesting. Citi says hedge funds are using dollars as the new carry trades. So just as the yen was so weak, we've seen our positioning sentiment on US dollars starting to turn much more bearish. You think? An environment where people are speculating about rate cuts has fueled risk appetite. So they're now, rather than selling yen to fund other investments, they're selling the US dollar to fund other investments. And let's see. Usually the upper end of the range. Housing currency. So that's that. And then next is Jennifer Lawrence, Gigi Hadid, and I don't know who these. I know who Jennifer Lawrence. Oh, and Emily Ratajkowski are now wearing Vans. This is dated 2 weeks ago. This is Mary Claire, Emily Ratajkowski, Jennifer Lawrence, and whoever this is, Gigi Hadid, I guess. So, as Bracken referenced in the earnings call, which was actually very positive, the numbers weren't great. The earnings call was super great, and we'll spend some time on that. If you want to be here for 5 hours, we could do it today, but I think we'll do it next week or the week after, maybe with Advanced Auto Parts. But they've got a machine going here, so that was an article there. U.S. Us Weekly or whatever it's called had another article 2 weeks ago, August 9th, talking about vans featured. So they're turning the machine on now that they've stabilized the ship. Our slip-on vans, the Sambas of summer 2024. That was a little while back. Small cars are selling faster than SUVs and trucks. Here's what's driving more buyers to settle for less. There's interest, there's volume. Hard to say if there's profitability. We don't care if there's profitability. All we need is volume for Cooper Standard. We do not care about Ford or GM's profitability. We care that they race each other to the bottom and put out millions upon millions upon millions of cars with billions upon billions of incentives. And we're back to 2017. The difference is this time, I think we can earn a lot more money on 17 million cars, 18 million SAR, than we did in 2017 when the company was bloated and earned $7 and traded 146. So super exciting to see all the stuff that we had anticipated that took a little longer than always takes a little longer. So you can count on two things. Number one, the theses are always going to take a little longer than expected. We have exceptions, obviously, that go super fast, and sometimes we catch the bottom tick. But you can count on two things. Number one, our first buy, it's going to go lower before it goes higher. We don't care. Our second thing that's going to happen, it's going to take longer than you expect, but we're still going to meet our IRR hurdles over a reasonable amount of time. And that's what we do. So McDonald's to invest $1.3 billion in the UK and Ireland over the next 4 years. It does not sound like a company that's slowing. It sounds like a country that's recovering. Key thesis there, GXO, smaller little play, ASOS, which, again, we don't have a reason to make it a real position yet, but we're waiting for that reason with bated breath. Bottom fishers snap up office buildings at huge discount. I cannot say this enough. I have a lot of super rich people that are my clients that listen to this with B's in front of their names, with lots of M's, hundreds of millions of M's in front of their names, that know this world. This is not what I do, but I'm telling you, so much money is going to be made buying these unbelievable properties at 80 and 90% discounts. So all I can say is I can see it. It's not what I do for a living, but I'm telling you, fortunes are going to be made here. Fortunes. So ARK Innovation Fund earnings estimates as soon as unemployment ticks up to 5% and everyone's scurrying back to work, scared to keep their job, and employers can start to demand. Look, every employer knows that their work from home people are less productive. That's statistically proven. So they just have no power right now because they don't have an abundance of labor supply. That's changing. Wait till that switch flips. Everyone's going to be forced back into the office and there's not going to be enough space. And I'm talking billionaires are going to be created out of this hole. This reminds me of the Orange County thing and Lou Ranieri in the 90s. Anyway, all right. ARK earnings. Why is that down? Well, it's because their earnings estimates are down 21% for this year and 12% for next year. REITs are up. Earnings expectations up 1%. And 2%. That is top 30 weights in the last 60 days. What's happened to revisions for 2024 and 2025? Utilities, their earnings estimates have gone down by 0.4% for this year, up 0.6% for next year. Price has gone up a lot. I think they're due for a breather. I think we're going to get a counter trend bounce. I think yields are going to go up a little bit. Oil and gas equipment services, earnings expectations down bigly. Negative 11%, negative 8%. That's why we haven't been shopping here. Our only energy exposure continues to be Comstock, which is up bigly in the last few months, from 8 to 11, or I don't know where it is today. CRK. 8 to almost $11. So anyway, that's a rounding error. It doesn't matter if it's 8 or 11. I think it's going a lot higher. Earnings estimates holding in there nicely. You can see here initial jobless claims. Again, these are big numbers. Fed is going to move. This is big news, and that supports all of our portfolio. We're lined up for it. All right, so the podcast is over. Now we're going to do the Ask Me Anything questions for those of you who want to stick around. We'd love to have you, and for the rest of you, you've had a long one, but I hope you've gotten a tremendous amount of value from Brendan and from everything else we do on a weekly basis. Jim Jones. Tom, you always talk about your current holdings. Could you talk about one that you're looking at and why? I really enjoy your podcast. One, we do every week talk about ones that we're considering and why or why not we haven't acted. Some of that comes out of the Ask Me Anything question. Some of it comes out ad lib. But our obligation is to our clients first. They get the priority of our best ideas before anyone else. Sometimes simultaneously, because it doesn't matter in the scheme of things, but because we're long-term holders, we're not buying it for a day or a week or a month. We could care less about short-term fluctuations. But our job is I'll give you an example. QXO, okay, that's a Brad Jacobs company. We've built a decent-sized starter position in it. I think at around, let's just see. Yeah, so QXO is Brad Jacobs' new vehicle. He wants to roll up home building supply companies. So we built up a nice size position at $12.69 across all portfolios. And that's the good news. It dropped from like 90. It had a small float, and they did a private offering at $9 or $10. So there are two ways to look at this one. So number one is you could say, well, it's just a SPAC. Who the hell is Brad Jacobs? And it's trading at $6. You get $6 of cash for $12 of price. That sounds like a stupid deal. Except for the fact that it's Brad Jacobs. And effectively, his model works. And every time he's done it, he's made his owner's fortune. So you could say, why would I ever pay $2 for $1 of cash? He hasn't done a deal yet. And the answer is because when he does a deal, it's not going to trade at $12. It's probably going to trade up to $20. And then you've missed the opportunity. And then when it goes from 20 to 100, you've only made 5x instead of 12 to 100. You've made 8x. So if you own it at 12 and he doesn't do a deal for a year and it drops back down to the cash price per share of $6, so I got 50% downside and 1,000% upside. Based on his, if you look at his, and maybe one time we'll spend it, but basically he wants to do $60 billion. He always gets 15% of the revenue of the industry he goes into, or I think it's 5 or 15%. I don't know. He's done it in Waste Connections, which was a waste management roll up, made billions. He did it for his shareholders in URI, which was like a 47 bagger. He did it in XPO, which was like a 37 bagger. We're going to get probably a multi-bagger in GXO over the next few years that was spun out of XPO. And I wanted to be in QXO because I know rates are coming down, and I know that the millennials are going to be demanding huge amounts of new housing for the next 6 to 10 years. And he's in the sweet spot, and it's a fragmented business run by a lot of boomers that are retiring that don't have kids that want to run the business. So these smaller businesses are going to be rolled up. And Brad Jacobs is going to do exactly what he does every single time, take these antiquated businesses, add technology, add efficiency, run them better, and scale them into a multi-bagger. So while the value of the cash is only $6 a share, I would assign him $5 billion of free value because there are only a handful of owner-operators who have ever compounded capital over decades at 20-30% for their owners. And to do it multi-times, none exist. I mean, there's not one that has had multi hits other than Brad Jacobs that I know of, like 3, 4, 5 hits. Some have done 2 and 3, but compounding at that level. So I'm willing to pay double the amount of cash in order to have a placeholder and a nice size position to participate in this. And I think over the next decade, it's going to be a beast, an absolute beast. Now, so what happens if it goes to, if he dithers and doesn't get a deal done for a year and it trades back down to the cash value of $6, then I get to buy more and bring my basis down to $9, and then I'll have an 11 bagger when it goes to 100 over 6 to 10 years versus an 8-bagger, okay? But I don't want it to run away from me and miss the beginning and then only have the chance for a 5-bagger, because if it takes 10 years, it starts to run under my required IRR that I mentally focus on. So I'll leave that at that. So Matt says, thank you as always for your generous giving of your time and expertise. Millions of people should be listening and taking advantage of your informative podcast. A lot more are listening than you know, because they not only listen through YouTube, they listen through the podcast. Anyway, so there's a lot more people listening than we even know. Thoughts on NASDAQ with impending IPO uptick, room to run? NDAQ. I mean, it's priced for perfection. It's performing like perfection. The gross margins, though, seem to be going down a little bit. Let's take a look at the balance sheet. Fortunately, I'm not on my regular computer today, so all right. Debt. We've got 10 billion in debt, and it looks like about 400 million in cash. I don't love that. I don't know. It's high single-digit compounder. That's good. What's the free cash flow? $1.5 billion. What's it trading at? Eight times sales, 10 times EV. Enterprise value, EBITDA, 20 times, 24 times. It's okay. It's fairly or fully valued. I don't see any edge here. I mean, this is like, you'll be lucky if you get a double-digit return every year. I'm not interested in that one. I understand your thinking behind it, but if you want to play IPO cycle, wait for a correction in banks and buy some of the best. Michael Digitano was wondering if the Hong Kong inflow into Alibaba will be announced on a fixed date. We covered that. Next. Dom, just a question regarding Dom Durham, free cash flow drop. We covered that. That was working capital issue because of the direct sales business and AI investment spend. Look at cash from operations was fine. Jason Lee. Has the business deteriorated since you got interested? No, it's improved. Kyle Burns. Goodyear Tire. I don't like this one because they just have an uncanny ability to lose no matter how good conditions get. The Koreans destroyed them, and they've got kind of a levered balance sheet. I think this works for a trade. I looked at this for a friend of mine, a client actually, this week. It probably works as a trade up to $20, but this is just a low-quality commoditized business. Jason Hauk. Hey, Jason. Excuse me, not Jason. Jackson Hauk. How are you, Jackson? Good to hear from you, my friend. Jackson and I got out on the links together in Atlanta. He's a super guy. Using official channels outside your norm. Okay. Begrudgingly sold Tesla at a 9-bagger, so looking for another long shot using the house money. The rest pretty much in your faves. Well, congratulations on your Tesla trade. Looking for another long shot. I would just say Cooper Standard. I mean, I think it's run up a little bit. I mean, look, Cooper Standard under 20 is cheap. If you okay, so all right, it's over $15 now. Even $15, I kind of like it. I think this has a huge. I don't know. Maybe you'll get look. If Cooper Standard goes back towards 10, back up the truck. I think as far as multi-baggers go, it sounds like that's what you're looking for. That's probably where I'd be focused. I'd also have some Comstock as well, and so on. All right, let's see here. But great to hear from you, buddy. We got to get on the phone. Oh, I'm sorry. Tilray. Oh, he wasn't asking me for one. He was presenting one. Tilray, cheap, near free, inconsistent product on financials, top line growth, adding solid beverage brands, Sweetwater, Montauk, added capacity with Molson Coors facility, on trend with THC beverages, good distribution. This is where money goes to die, my friend. Tilray. Let's see. Jesus. All right, let's just see if they're going to live. If the balance sheet's okay and you want to take a punt on it, I don't think the balance sheet's okay. Let me just see. I can never recommend this. I just want to make sure. I just want to see if you're definitely going to get hurt or only probably going to get hurt is what I want to really get you to here. They just continue to burn cash. Oh, every time that guy goes on TV, I just feel like never mind. All right, their balance sheet, let's see. Got $280 million of debt, which is not a lot. So the balance sheet looks okay. They're burning cash. So you need a catalyst before they run out of cash, is all I can tell you. I mean, let's see if they're growing revenues. Yeah, I don't know. This is a tough one, my friend. This is just Gamblers Anonymous here. I would never buy this for clients. I don't think I'd ever buy it personally. I don't know. Just help me understand why they're going to live. I guess Sweetwater, 420, Shock Top. Shock Top, isn't that dead? I wouldn't put my own money in it, but you might catch it. You might catch a wave. They might get a favorable, you got an election coming. I don't know who's going to give them smart banking. That's been the whole key. His view is if Kamala and Walz win, Schedule 1 to Schedule 3. What you got? If. I mean, Biden, everyone thought Biden was going to help these guys out. He didn't do anything. So Biden is I think Kamala is Biden part 2. So even if you're right, you might not get what you want, but it's a free option on it, and option has no expiration so long as they don't run out of cash. It could work. I can't recommend that to you, buddy. I really can't. And I'm stuck because if it goes to 10 or 20, you're going to hate me. And if it goes to 0, you're going to hate me. So there's no win there. It's outside of my circle of competence. You know those brands better than I do. I can't say anything about that. Joseph Naus. I'm the golf guy that always comments on your YouTube. I know, Joseph, and I think you're also an author, if I remember correctly. Thanks for your content and being so consistent. Go Baba. Anyway, I've been wanting to ask a question forever. Seems to me every investor believes that insider management buying is a 100% indicator of the insider management believing the stock will increase. And so it would seem to me that there is a possibility that the board of management would buy stock to send this signal to the market even if it didn't believe it. I can imagine, especially in a company with small market cap, a wink wink from the board, some CEO or components to be used for this purpose. Are you aware of any studies on this or examples? It would seem that would be easy to figure out if there is insider buying just before bad news comes out. I know there are academics who do these type of things. I wouldn't get, the one thing you want to consider with insider buys is how material is it relative to their wealth. That's, if it's token, then it could be to send a message. But the bottom line is the studies show they're right more often than they're wrong. But you got to do your analysis. So, like, if I'm at a point of buying and then I see insiders buying on top of it, I get very excited. Insider selling means nothing because they only buy for one reason. They expect the stock to go up. They only sell for one reason. And they don't get enough bump. Like, it's not like the stock's going to go up 10% because the CEO buys stock. Unless it's some penny stock or garbage promote. So I wouldn't be that cynical about it. And I wouldn't consider it that indicative either, because some of these guys, I look at insider buys every single day, and some of them are buying stocks that are way up fully valued. In other words, they drink their own Kool-Aid. So I get more interested when people are buying a meaningful amount of stock relative to their net worth when the stock is washed out and the balance sheet is good. So, P.S. I'm writing a book that will be entitled So You Want to Be a Scratch Golfer. And when it's published, I'll send you a copy, Audible if you like. Yes, you know me very well. It's directed at guys like you and me, golfers who took up the game earnest as adults. Awesome. We'll be looking forward to that. I'm sure you'll get a bunch of clients from the podcast. And then he's giving me some putting advice, which is fantastic. I'm actually putting well since I got that Lab Golf putter. That brought my index down to 11.4, and then I've just completely had 3 really bad rounds, just not hitting the ball. So I'm going to get that fixed. And it never ends. I was hitting the ball like a pro when I couldn't putt, and now I can putt. I can't hit the ball. Anyway. But we keep coming back. It's like an abusive relationship, golf. It's unbelievable. Bob Johnson, hope the Olympics have inspired your kiddos to get even bigger. The women's water polo team could have used some help. Yeah, no question. Can you take another look at Airbnb at this juncture? Feels like a better play compared to Nike and Lulu. If I had to pick one, consumer discretionary. Balance sheet is getting better and better quarter over quarter. Enough free cash flow to start buyback stock. New business model from long-term rentals. Co-hosting with AI Concierge. Founder-led CEO. Seems very motivated. Yeah, I looked at this a couple weeks ago, I think, and I just passed. I understand what you're saying. Yeah, revenues are going up. Net income, yeah, it's all recovering. Earnings per share, 7, so it's trading at good earnings growth. Multiples. Yeah, they do kind of have a moat in their space. Just wondering how much of this, people are starting to go around it. In other words, once you rent once, then you just go right to the owner, like Fiverr and some of the other companies that blew up with outsource Free cash flow looks really good. I think you're going to get another chance below 100. Just be patient on it. That's what I would say. And go spend a lot of time on the conference calls. I'd listen to the last 8 calls, read the annual reports, see what they said they were going to do and what they actually did. What's the balance sheet look like? 7 billion, 1 billion. I mean, you might have something here. I think it's a little early. So hang in there. Good find. It's been on my radar. I'm nowhere near ready to do anything with it. Ahern, Oda. Thoughts on Toyota? No, I don't want any OEM. I don't want any original equipment manufacturers. I want Cooper Standard, regardless of how cheap it is. But Toyota is the only one who got it right. That CEO said EVs are not going to have the demand you think. And they said, you're wrong, when everyone was ESG and blah, 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 and forcing it down people's throats. And he actually had to step down, and he turned out to be the one that was right, and everyone else, Mary Barra, doing cartwheels in Washington, blowing shareholders' money, and blew it up. So, okay. Alan B. So no Toyota for me. Hello. Send it back in when it hits 140, when it's down another 20%. Alan B., thanks for putting out the best investment podcast out there and encouraging the long-term mindset on the regular. Could you please take a look at Portillo's? Oh my gosh. Engaged Capital. I think he's a member at my club. I was supposed to play with him last week, and it rained. That's crazy. Okay, so he's in that, and he's in VFC, which that's mind-boggling. That'd be interesting if it's the same guy. Got to reschedule that 18. But anyway, pushing for a turnaround at Portillo's. I was at Portillo's for the Olympic development thing in Texas, and I think we covered it that week, and I like it. I just wouldn't put clients in it, but maybe now I'd be interested. It didn't have enough operating track record, but this thing is a great business. It's just the restaurant business is really hard. And right now they're going to get hit by the lower income consumer for a little while. Free cash flow. I think I'm okay with this one, but I wouldn't put clients in it as too risky. But if you take a long view, I think they've got a growth trajectory. We covered it in more detail, 4 or 5 months ago. I think it was December of last year, maybe 8 months ago. It's just growing very slowly. What's the cash flow like? I think they were burning cash at the time too, which bothered me a little bit. Yeah, still negative free cash flow. It's just not a great business. It's a good business, a good product. It's just not a great business from a stock standpoint. It's too slow. For a business that small, the growth rate is too low, so that's why it's a pass. It'll probably work. You'd probably get a double on it, but... Len McAdams, could you take a look at Cleveland Cliffs? Yeah, that's in the materials. I've looked at it. I like that guy. We actually talked about this 2 weeks ago, so I'm not going to do it again, but thanks for tuning in, Len. Eric Haney, and I said, meh. It's a meh for me. It'll probably be okay, but not for me. I do want to get materials exposure. Cliffs. All right. Let me take another look at it. I'm going to be having dinner late tonight for my awesome viewers. Want me to look at Cliffs. Let's see here. All right. Free cash flow is good. Revenues are okay. I mean, send it back in if it gets to 10 or 9. Wow, it's a lot of free cash flow. What's the balance sheet look like? $3.5 billion on 110 million. So that's their problem, is their balance sheet. So you got to know when all of their debt matures, what are the terms, and on that basis, then, you know, I don't think they're going to have solvency risk, but, you know, the number one thing you need to figure out is, why is it down? What's the bearish thesis? And why is that incorrect? I mean, it's obviously, I just don't like this type of business that much. Yeah, so I'm agnostic on that one. Eric Haney, big fan for over 3 years. My man, good for you. Thank you for all you do. Thoughts on ATKR? This looks like a broken stock. What do they do? Cash flows rolling over. Their revenues are rolling over. Electrical infrastructure products. Yeah, I just want to know what the turnaround plan is, because that's a pretty precipitous drop in revenue and free cash flow. Free cash flow's halved, almost halved in the last couple of years. And then multiples. Yeah, I see what you're seeing. I mean, just help me understand why these revenues are going to reaccelerate, and I'd be more interested. But it's from 4 billion down to 3.9 down to 3.2. That's a big drop. So what's the plan to stop the bleeding and start to turn it around? And then from there, you might have something. I mean, it's down a bit. It was a go-go growth company for a while, 14 to 193. But, you know, yeah, it's dropped 50%. But these broken stocks, man, once they hurt the institutions, could it bounce right back up like it did in 2022? Yeah. I don't know. My spidey sense just says to avoid it for a little while. Wait for more pain and then revisit it and keep following the thesis. Remember, this business, you get paid for inaction versus action. You're much better with errors of omission than errors of commission. So be willing to let a few get away from you. It's just the way it goes, and that's good, because if you chase every shiny object, you're just going to spread too thin and you wind up hurt more often. You know, you want to go in when everything's pointing in your favor. It's the fat pitch down the middle, and you knock it out of the park. So with that said, we'll be back next week, same time, same place. Much shorter video cast. Until then, make it a great one. Bye for now.